In physics, a sphere is defined as the set of all points in a space that are equidistant from a common centre. It allows for a complete 360-degree revolution around a central point. As a vertically integrated investment company, this 360-degree phenomenon represents what we call the PEG experience.
Right now, markets across the globe are being disrupted. You have climbing interest rates, civil unrest, the war in Israel, a presidential election here in the US this year. Tensions are high and investors are feeling the economic turbulence across the world right now as a result.
As we look at where we're at today as a company, and as I look at where the market is, we want to acknowledge things are tough right now and values are down, returns are not there as we expected. And we recognize that, and we recognize that we're going to have to work extra hard just to protect those assets, because we truly believe that this is a blip in time.
Our primary focus is protecting the assets that we have on balance sheet and maximizing the value for our investors. We are working all day long, every single day, to do everything we can to protect the value of our assets. And first and foremost, that is our primary focus.
Sure, it's a crazy time in the world right now, but for commercial real estate investors, it's also a really exciting time.
What really differentiates us at PEG is that operational capability and the fact that the returns that we're focused on here at PEG are returns that are primarily driven by the operations and the value that we're creating on the ground at each of our assets.
We have 5 synergistic companies that work together to maximize returns for the benefit of our investors. Our world here at PEG revolves around our partners and their investments.
During challenging times, it's critical to be nimble, adaptive, quick on your feet, and to operate properties efficiently. And that's exactly what PEG's positioned to do.
Being a full-service, vertically integrated firm means we have complete control and power to protect the investments however we need to at any given time.
Our eyes are also open to the opportunities that have begun presenting themselves in this market cycle. This year, we're excited to announce the launch of our 5th and 6th funds, both focused on the acquisition of multifamily and hospitality distressed assets.
These are the times when you look back in history that when investments are made, that you can really earn the best returns.
We're excited to peel back the layers and not only offer 360-degree visibility into our PEG company's organization, but also into the opportunities of today's environment.
Welcome to PEG360, everyone. We are so excited for each of you to be here, those that have traveled from Utah, those that have traveled from outside of Utah, and those that have traveled from outside the country. And what a beautiful place. We love to be up here in the mountains, and this year we don't have 10 feet of snow around us, so hopefully you can enjoy the greenery, and it's supposed to be sunny today. So appreciate those, like I said, that are here. We also appreciate those that are watching virtually. We do have a virtual link that we have people watching today, so we appreciate that. So last year we had a kind of a tumultuous year, I would say, or a lot of tribulation with interest rates going up, costs staying high, rents stabilizing or not necessarily but flattening. And so we put a lot of work into the real estate space, and it's been challenging for us, as most of you know. But we do have a good team, and you'll hear more today about that team. However, we have had some successes at PEG that I'd like to talk a little bit about or identify. First, we opened the Moxie Hotel in downtown Phoenix in a 100-year-old building. That had some challenges. Hopefully, those challenges go away. We've opened strong. That's in an ozone, one of our ozone assets in our first fund. We opened Revival at downtown Salt Lake. As much as we see supply in that market, a lot of supply in that market, that property is actually leasing up better than we thought. So I looked this morning, I think we're almost 50% leased. So those are two of our opportunity zone fund assets from our first fund. We've also continued to see success in our Avia brand. The Avia brand's actually I'm gonna talk about Alante first. We have the Alante brand, which is our build for rent. We continue to find properties and start construction on some of our communities. That's been a little bit more challenging, these single family for rent or build for rent communities, because of entitlements in some cities, but we continue to push that brand and see a big benefit there. Then Avia is our extended stay conversion brand, which we continue to open and have success once we open by leasing up. The challenges we get through with entitlements. Some of the other things that PEG has recognized was we were recognized in Utah as one of the fastest 50 growing companies in the state. We also launched our first podcast to really talk about our industry, hosted by Rachel Lowe. It was called Peaks and Portfolios. So if you guys haven't followed that, please follow it. You'll hear some interesting content with some of our partners and leaders in the industry. At the company level, we've had some changes, and that may be why some of you may be here too. I was telling somebody we try to create something new every year. Last year was a party. This year we've changed and added a co-CEO. We get you here to the meeting, so hopefully you can get some good content out of it as well. But first of all, we actually we've promoted one of our people in-house to our Chief People Officer, first ever, Rachel O. Where did I see you? If you would stand up with, or Rachel Asbury. We have too many Rachels. Rachel Asbury, thank you. She's now our Chief People Officer, which is good for us because she really helps with our people, our team, and helping them feel part of what we're doing in that experience. So, and then most of you know we have the co-CEO, Garrett Bjorkman. Where is Garrett? I'd like to have Garrett come up and at least say a few words, and then we'll hear more from him. But Garrett will be a huge addition. He's already done so many things at the company so far. But Garrett, welcome. We're excited to have you.
Thank you. No, thank you. Thank you. No, I want to thank Cameron and thank everybody here for having me. It's incredibly exciting. You know, I'll save most of what I have to say for later. I think we have an amazing agenda set forth. Some great speakers here this morning. We'll talk a lot about what we're doing with the assets today, how we're really trying to maximize value in the portfolios, and then talk about some of the opportunities. So look forward to spending time and meeting all of you throughout the day, and you know, enjoy yourselves while you're here. So thank you.
Thank you. We're excited to have Garrett. I think Jamie's most excited to have Garrett. So we have our favorite MC that I would like to introduce, and it doesn't take much. She doesn't take much introduction because she's so dynamic and lively, and most of you know her. She is looking out for each of you as well, making sure that we're performing on what she tells you we're going to do, and she's very good at listening to our investors and being able to come and report back to the C team on the things that are important and things that you're seeing, the challenges that you may be having. So we really appreciate Rachel and her care and her concern for the investors, and we appreciate all that she's doing out on the road, raising capital for us. So without further ado, I know that Rachel will keep this meeting very lively and on time. So Rachel. Only 2 minutes off.
Okay, well, that was super, super nice. So apparently I'm going to be working more hours this month. No, I was kidding. Okay, so a couple housekeeping items. I don't know if you guys all saw this, but there is Wi-Fi access. You're going to want it on your phones and on your laptops if you want any connectivity, because it is completely a dead zone here. And if you want the agenda, we're trying to go paperless, so you have a tag. On the back, there's a little QR code. scan that. So, okay, housekeeping is out of the way. I love being here every year, seeing all your faces. I tried to give each and every one of you a hug, so if I haven't yet, I'm so sorry. But thank you for joining us. I know that there was like a crash. I think there's a pretty deadly crash that just happened last night or something, so hearts are out to those folks. But thank you for taking the time. We have been very deliberate in our theme this year. I want to be very clear. We're not an allocator. We're not a development company only. We are not a property group. We are soup to nuts. We are here to protect your investments. You're going to hear about that all day long, but we are PEG360. That is super important. And so we are going to try to help assuage any concerns you have and really show you what we're going to do to maximize your investments. And as Cameron mentioned, to do everything we can to deliver the returns that we had originally discussed. So we'll talk more about that. So to kind of help start this, we're going to have a more macro view or explanation of what's going on. We have brought back Ian Wright, who is an assistant professor at Brigham Young University in finance. He is one of our top-rated speakers. Granted, we haven't done too many surveys, but on the one survey we did, he absolutely outshined everyone else. He's going to be speaking on connecting the dots, macroeconomic factors and market outcomes in an uncertain world. You can read his full bio, but I think what's super interesting about him is prior to BYU, he was a quantitative macro investor in a $20 billion fund at BlackRock in London. He was also the executive director in the Asset Allocation Research Group at Goldman Sachs in London. So he has extensive background and information for us. So without further ado, let's welcome up Dr. Ian Wright. Where are you, Dr. Wright? There we go.
Okay, let me just make sure I get this queued up. Okay, great. So my task today for the next 20 minutes is to walk you through, like, relatively quickly a macro overview, and then what I'm going to try to do in terms of harmonizing it between both kind of academic training that I have as an economist, but then thinking about what practical implications are there for investors, because that's my background, right? Like trading macro assets and thinking about that, which I think hopefully will be most relevant for you all. All right? So just going to jump straight in if I can get this to advance. Just the green button, right? I think it's showing up on that screen. So we might need to move this, change the screen. Brilliant. Okay, great. Thank you so much. Okay. Just 1 second while this loads. Okay, brilliant. Okay, so here's what we're going to do. Spend the first little bit talking about, like, the past 3 to 5 years. I think everyone thinks that they always live in an unusual time, right? But it actually is the case objectively, if you look at macro variables, that the past 3 to 5 years actually have been an unusual time. Okay? So COVID shock, that did happen. We've largely forgotten that now, right? There was a recession for sure that was going to come out of that has not occurred, right? But if you go back 2 years and you ask, maybe now everyone is claiming, yes, we thought there was going to be a soft landing. The fact of the matter is, no, actually people did not claim that. There was one house on the entire street that claimed that. It was Goldman Sachs. So no matter what anybody says, they were the only ones that called it, right? And the reason that nobody thought that was going to happen is because since World War II, you have never had a soft landing, okay? And so this is the first time where we're, like, in that type of environment, and it's very hard to be able to declare victory, right? But that's led to some very unusual conditions relative to history, all right? So we'll talk about that for a little bit, and then after that, we'll roll into kind of what does that mean for current markets right now, future expectations, short-term and macro variables, and then risk investor implications, all right? So this chart, I'm going to go relatively simple with the charts. They should be facts that we all agree on, but sometimes forget, right? This is just real GDP year on year, okay? That's the blue line. So along the y-axis, it's just the percentage growth in, like, real economic activity in the US, all right? And if you go back, you see in, like, the 2010 period, right, it's about 2.5% on average throughout that decade, okay, which is lower than it had been previously, but, like, relatively stable and not that much uncertainty around it. You have the COVID shock that happens, right? And here, when you're looking at the gray bars, okay, all of the gray bars are recessions that you experience. So you see, like, that blip during COVID, right? The shortest recession we probably ever will experience in our lives, and you've seen in history. Okay, and then you got paid back in terms of growth more than you had lost during the period when COVID kind of shut everything down. And what's been interesting is that actually, as you look at what was happening coming out of that, with that growth deceleration, anytime that you've seen a growth deceleration like you saw in 2021, right, and 2022 as the Fed raised rates, right, during that period, it always led to recession in the past, but not this time, okay? And actually, although it looked like we were headed straight there, no, now you're in this environment where you're stable again at like 2.5% growth. The most recent reading from Q1 of this year is like 3% year-on-year real GDP growth, okay? So an unusual kind of growth backdrop and environment. This is also true if it's true of the macro variables, it's got to be true of like individual sectors. For this crowd, I'm guessing like travel hospitality is going to matter quite a bit. So putting a slide in on that, right? And looking at this, and this is like truly amazing what we are seeing. For a macroeconomist, like looking at different sectors, I feel like if you're in it, sometimes it's hard to necessarily appreciate it as much, right? But seeing what this chart shows, which is the blue line is showing you air transportation from personal consumption expenditures, okay? So no business expenditures that are in this. This is just like personal households and like air transportation spending, okay? The red line is showing you foreign travel by U.S. residents, so it's like kind of another proxy for like travel that they collect at like the national level, okay, in the U.S. And when you look at both of these things, there's two things I would point out. The first of them actually is that when you look at the 2010s decade, okay, during that period, you had roughly 8 to 10% increase in like spending in these categories, okay, which was significantly higher than you actually had pre-global financial crisis. So there was already a trend of like increased spending in this space. COVID comes, obviously disrupts this massively. You get a significant bounce back from that, but it has more than paid you back, right, in terms of the spending that you're observing in this space. You can see this via a lot of channels. It's very popular in press, right? Hotel bookings, like this type of thing. But to put a number on it, if you just look at like household air transportation, okay, as like a proxy for travel more generally, right? It was at 120 billion prior to COVID, and now it is roughly around 200 billion, right? So when you annualize that, I mean, you're talking about like an 80% compound increase over that period, and like easily double digits, even taking into account the COVID shock over that 5-year period, okay? And so you've just, it is incredible what you're seeing in kind of this cyclical area in terms of the rebound, right? If we move over to labor markets, so here the blue line is the unemployment rate in the US, the red line is the unemployment rate in Utah, for those of you that are local. This is always lower because Utah's a business-friendly state, right? Okay, than the national average is for unemployment. But if you look at this, what is strange is look at the end of this chart, okay? You're seeing that like unemployment is like been relatively flat. Now go look back in the past when unemployment is starting to flatten out. And the number you can attach to is if unemployment has increased by 0.3% in a space of 3 to 6 months, a recession always has happened since World War II. Okay, this chart only goes back to 1985, so you don't have to look as crazy like ocularly at everything, right? But if you took it further back, you would see that, and you see it in these periods, right? You tend to get like relatively quick inflection, which you have not had this time. Okay, you're getting this rebalancing happening in the labor market without actually getting a significant increase in the unemployment rate, okay, which is incredibly unusual relative to history, right? If you look at inflation, right, so this again like avoids the period of the early 80s. I'll show you that chart in just a second. Okay, you see like the inflation spike that occurred. The blue line here is CPI headline. The red line is core CPI, okay, year on year. And when you see this, you can see like the spike happened, we came back, now it's settled around like 3.5%. It's lower if you're looking at PCE, which we'll look at in a minute. That's the thing the Fed focuses on, personal consumption expenditure inflation, okay? But right, like it had been like sub 2% around that area for the decade of the 2010s, 3 to 4%, something like that, previous to that. But then you see this like massive round trip in a very fast way, which is incredibly unusual when you put it in the context of history, okay? So again, gray bars are recessions. When you have had such a fast reversion in inflation in the past, it has always been the case that's associated with recession, okay? And that is not what we've had to happen here. So to some degree, we need to say, wow, incredible job, Fed. Somehow you have raised rates massively and not actually crashed the plane, to continue on like the soft landing type of argument, okay? The challenge for them is that they'll never be awarded a medal for that. We constantly sit here, and if there's a recession in like 3 years, right, people will say, wow, I don't know, was a soft landing accomplished? But it's very difficult from an investment perspective to sit there and wait for the 3 years, okay? Even though that may be what some are inclined to do, and we'll talk more about that in a minute, okay? The last chart I want to show you associated with kind of the unusual past 3 to 5 years. These are interest rates. So the effective federal funds rate is the blue line, the red line is the US 10-year treasury yield, and then the green line is the 30-year average mortgage rate, okay, to give you kind of a swath of these along the term structure, and some that have credit spread, some that don't. Right? You can see the cycles in the effective federal funds rate. You see the massive bull market in bonds that we're all aware of that's happened since like the mid-1980s, right? And the thing I'd flag about the past 3 to 5 years is that we know interest rates have gone up, but you have actually never seen interest rates go up in a synchronized manner like this, in a magnitude that they have, and then stay where they are, right? That is the thing that is incredibly unusual, is how synchronized that move is across the term structure, and then how high they have remained during that period, and it seems like they're very likely to stay there. Okay? Now this has had massive implications, right? Fundraising, valuations, all of these things. I'll talk more about those in a minute also. But having in the back of your mind, like, it is actually unusual what we are seeing here relative to the past like 40 years. So where does that leave us now in terms of future expectations and current environment? So what I'm going to show you in the following charts, all the charts are going to be similar, all right? Where the black bars that you see are FOMC, so the Fed's projections that they made in March. Unfortunately, they only make them every 3 months, and so we got to wait till June to get the next projection, and there's a little bit of data that's come out the past couple of months, but it's still useful to anchor in like what they thought in March and what's their most recent forecast. Okay, and that's going to be the black bar on all of these charts, and then the orange bar is going to be a little bit more timely of a measure, all right? So this is going to be the survey of professional forecasters. It's collected by the Philadelphia Fed, and when you're looking at this measure, it came out in May. You should think the stuff that goes into this are think tank economists. It's, you know, Jan Hatzius from Goldman Sachs, who's their chief economist, Bank of America chief economist, right? Some academic economists. So this is a broad swath of non-Fed forecasters that go in there, okay? So this chart is showing you the growth picture, right, to like anchor back to these same macro variables. And you can see growth has been surprisingly strong, right, 3% year on year right now. And then it's going to slow, but like not that aggressively, right? So in the next couple of years, you kind of drift down to around a 2% real GDP level by end 2025. So each of these years, we're talking about like what's the forecast for the end of that calendar year, okay? If you look at unemployment, this is probably the least interesting chart I'll show you the whole time, and you may sit there and say, why did you just copy the bars all over the place? And the fact is that that's the forecast, okay? Unemployment's at 3.9% right now. It's increased from 3.5%, right, previously, a couple of years ago. But then when you look at where it's forecast to go, it's like 4.1% in the next like 2 to 3 years. So unemployment like remarkably stable, both from the Fed's perception and from like broader market participants and forecasters' perception, okay? When you look at inflation, right? So they're always wondering about this, primarily because we were so affected by it over the past couple of years, right? You see that like this is PCE inflation instead of CPI. It's at 2.7% year on year right now. You can see the difference between the bars in 2024. That's probably due to the FOMC, right? Like being surprised by how resilient inflation has been over the past couple of months, right? But in either case, like it takes you 2 to 3 years to kind of get to the Fed target of 2%, which is what it is in 2025, 2026 when you're looking at forecasts, right? And so no dramatic changes and just like ultimately a kind of grind slower down there. And then lastly, talking about interest rates, okay? So all of the Fed speak right now points to interest rates higher for longer, right? Inflation surprised the upside. You haven't had unemployment spikes, so it's really hard to push back against that argument, right? With that being their dual mandate. You look at where rates are now, the most surprising thing about this chart is if you look out to 2025, 2026, okay, and here the orange bar is Fed markets, Fed futures pricing, okay, so it's market participants as opposed to just forecasters, okay, so there's like money behind the orange bar, right? It used to be the case that there were 6 cuts forecast for 2024 in the calendar year. Right now, if you go out to June 2025, there are 3 cuts forecast, okay, so like massive repricing in terms of interest rates and expectations of like, is the Fed going to become more accommodative, okay, because inflation has been so resilient and because growth has not struggled as much as people thought it would and unemployment has not increased massively to tie it into the previous charts, right, okay? And what's incredible is that investors have somehow overcome the recency bias in this, where even though interest rates for the decade of the 2010s were basically 0% from the Fed, investors have sat there and said interest rates are going to settle at around like 3.5% to 4%. That is the world we live in, okay, in a longer term horizon. Like that is what the pricing tells you, those orange bars when you're looking at like 2025 and 2026. It's like it's leveling out and it's around like 4%, which is actually in line with kind of the historical average when you're thinking about interest rates and Fed funds rates, okay? Now the implication of this, and now I may slow down just a tad, right, is that higher rates like these lead to more attractive valuations, and you've seen this across asset classes, okay? So I'll explain the chart and then I'll give a little bit of a narrative around it. The chart, what it's showing you is in 2021, at the start of that year, so just January 4th, like first market trading day, okay, what were values of different yields? So higher is obviously going to mean valuation is better, right? And then this is looking at, again, across asset classes. And then the orange is showing you, as of Friday close, what was the case. Okay, so you can see the Fed funds rate obviously moves from, 0 to 5, north of 5, the US 10-year yield actually having bottomed like closer to 60 basis points. It's incredible to think about that now, right? North of 4%. US investment grade yields more than doubled. US high yield yield almost doubled, right? Mortgage rates we're well aware of, like roughly tripled. Okay, and then you look at S&P earnings yield, and even that, right, 3.5% to like around 5%. So you're seeing that across asset classes, valuations are massively more accommodative and like appear more favorable than they have historically, right? When we're thinking about history being the last like 3 to 5 years, or even a lot of the decade of the 2010s, to be honest. Now, amid that, you're actually seeing significantly less capital, So a lot of the rallies that you're seeing in some of these asset classes are extremely low participation, okay? Now, why is that? Okay, I think part of it's because investors have this perception of our risks really high right now, and I'm going to talk about that like in the next section, in the concluding section of the presentation, right? But it's led to an environment where fundraising is just incredibly difficult. I think Cam alluded to this at the beginning, right? If you go back to 2010 and you look at like fundraising in the commercial real estate space for funds, okay, you had your worst year in 2023 that you've had since 2010, okay? So really in like the past like 12 to 13 years. And the question I would be asking as an investor, so trying to blend like the economist part of me and the active investor part of me, right, is that right, okay? Is it an opportunity, or is it like people are correct to be cautious in that environment, all right? And that's where we're gonna go right now, okay? So when you think about the current backdrop, are there still risks? Yes, always, right? And there's known unknowns, and then there's the unknown unknowns. The unknown unknowns you can't really do anything about, right? Because you don't know them by definition. Okay, the known unknowns, right, you got to think about those and say, how much are those really going to matter, okay? So I tried to isolate the three that I feel like people are bringing up the most to me, okay? And it is elections, number one, right? This happens in November. Now what's fascinating, and I'm going to talk about investor behavior around like each of these risks generally, is that elections really start to get priced as you get into like the end of summer and like start of fall, okay? Right now, people don't really think about them. You don't think a lot of capital like flowing through that. And the other thing that's interesting about this, because I was working at Goldman when the 2016 election happened, and so we did all sorts of back tests, I feel like for 6 months, or not 6 months, more like 3 months. All that happened with the investor base, they said like, what's the implications of like different parts of the election? Both slightly before, like 2 months before, and then 1 month after, everybody's just asking about this, right? And you find that like the mistake investors make around elections is to take capital off the table, like almost every time, okay? They go into elections and you see it in data, like people pull back risk, and then you get paid to carry it through the election, okay? Because people worry about like, is there gonna be some very, very adverse scenario that happens, and like that just generally does not happen, right? And so you get paid a significant amount of capital to, or return to hold risk through events. Second is like financial and regional banks, okay? So we're all aware of the shock that happened with like SVB in March 2023. If we look back at that, right? What's fascinating is if you look at public equity performance for regional banks, for S&P 500 banks, for US banks more globally, there's like a variety of measures you can look at it. Since March 2023, it is flat relative to the S&P, okay? And so there's been a significant amount of pressure that got priced in around that, right? And then it hasn't gotten worse, it hasn't gotten better when you're looking at it like relative to the market. Credit spreads tell us something slightly different. So if you look at investment grade and high yield financials credit spreads, you actually see, taking those back to kind of March 2022, that you are now at the level that you were when the Fed started hiking interest rates in 2022, okay? So there was a lot of pressure priced in on these, and then they've like tightened back again to like when the hiking cycle started, where were they, okay? And the last thing is like global conflicts, geopolitics, right? So these things, right, we hear a lot about, they dominate news. How worried should we be about these, okay? And what's fascinating is you can see that like there's predictable price patterns that usually happen with these, okay? So when you first learn about the event, there's two types of investors. There's types of investors that try to understand what their exposure is, and there's types of investors that say, I don't know what my exposure is, get me away from that thing, okay? Now it ends up being that you want to be the former as opposed to the latter, right? Because usually you get overshooting of prices around these types of things by people just kind of blindly responding to them, as opposed to understanding like what exposure do I actually have, and let's be like really thoughtful about this risk, all right? So I don't want to spend too much time on like what mistakes do investors make, like things to avoid, this type of stuff around those risks. The real point of this slide is just to illustrate like these most talked about like risks, they are known. The market has been knowing about these for a long time, okay? It is not like they're lurking and we're just not aware of that thing. Investors, we get paid to take risk, all right? And so to not take risk amidst these being there ultimately means I disagree with how the macro pricing is pricing these, okay? I think I should be getting compensated more, which you may have that view, right? But like coming from the perspective of a macro investor, like macro markets are incredibly efficient oftentimes, right? And so these risks in macro markets often, you have to have a really compelling case to start disagreeing with like what is market pricing, and that's going to cause me to keep capital on the sidelines, all right? Concluding topic, thinking about how the market is pricing risk, okay? So the VIX, sometimes known as the fear index, this is the market's expectation of 30-day volatility on the S&P 500, right? So it's the most liquid measure we kind of have, right? Even though it's specifically the public equity market, of how concerned is the market, or like what is it thinking is going to be problematic in the near term, right? And you can kind of get this going further out, maturities beyond just like 30 days, right? The orange line here is the current level, and then the black is showing you the historical, right? So you can compare. And you can think about these in percentage terms. The historical average of this is around 20. Think about that as like a standard deviation of S&P 500 returns, okay? And when you look at this, right now on Friday close, it was 11.99, which is 9th percentile, okay, relative to history. And what happens oftentimes is investors look at this number, right? So I was working in 2017, also at Goldman, when you see there was another period where this happened, okay? And we got this question all the time. How concerned should I be? Because the market is pricing like an incredibly low level of risk. What should I be doing in this environment? And the conclusion most investors reached was, I should be taking chips off the table. Because if the market is pricing an incredibly low level of risk, it's got to be wrong and can't appreciate that like this thing can only go up, okay? Now, I would ask you, look at the periods historically. Mid-1990s, mid-2000s, mid-2010s. You wanted to be long, risky assets like a maniac during those periods, okay? And that is the mistake investors make. And I personally believe, like, are making right now, okay, is that they are saying the market's perception of risk as priced here is low. Look at all of these other things that we just talked about in the previous slide, okay? It's got to be the market's wrong. Don't deploy capital in risky assets, okay? And from my perspective, we've seen it before, we'll see it again, right? And here's like a chart that illustrates this in just like the closing minute that I have, right? This is showing you just very clearly, when you look at that measure of risk and it's below 15%, the environment we're in now, that's the black bar, okay? When you look at the measure and it's between 15 and 30%, so like more risks are priced, that's the orange bar. This is like the returns you have gotten historically in public equity markets. You get rewarded for taking risk when the market actually perceives that like risks are lower. It ends up being that you don't get like significant financial crises that come out of an environment where the market like is saying investment should happen, okay? So in closing, the main point I would make is we're in a soft landing environment, okay? It's been 2 years. You're very unlikely to see material shifts in interest rates and material shifts in inflation or growth or this type of stuff now, right? And so from an investor perspective, I don't know how you can't look at this and say, we're in a soft landing environment. I need to like say that is likely to be here for the next 2 to 3 years, and I probably need to invest in line with that likely being the case, would be the first thing. The second thing is that investors are very unwilling and like not disincentivized, but they are hesitant to take risk in that environment because of the stuff we just talked about, right? They're saying, wait, should I really be deploying capital? Okay, when like fundraising costs have gone up, right? And like market's perception of risk is low and that type of thing. And the answer is yes, like you should be deploying capital in that environment, right? The other thing I should say is like they hired me as a third-party objective, so they actually didn't know what I was going to say before I got up here necessarily, all right? So you may be thinking, and my reputation matters way more to me than necessarily what saying something exactly what PEG wants me to say. So I'm not just saying this because they said like you should say this in this meeting, just to be very clear, okay? But like it's because literally I lived through this in 2017 and saw investors make this mistake, where they said no, too many risks, don't deploy capital, and then lost out on like material rally. The last point I'd make is just alpha is going to matter a lot more than beta returns in this environment. What do I mean by that? Okay, if you're not having like significantly trending macro variables, right? If you're not expecting a significant deceleration or acceleration of growth, interest rates, inflation, like the main things that oftentimes drive returns, then practically that means that manager selection is going to be really important. You can't just buy any fund, right, and sit on it. It's going to matter like where you invest and park the capital within whatever asset class it is that you decide to invest in. Thanks a lot for your time.
PEG Capital Partners is the investment management arm of PEG companies.
It's where we evaluate projects and decide if we're going to move forward with them.
PEG Capital Partners is comprised of investment management, asset management, fund management, and the capital markets group.
It's the select service and extended stay.
The investment management team sources out the deals, and then they conduct all the underwriting and due diligence, and they're the ones that pursue the investment strategies that PEG is involved with.
When's the next pivot for this hotel?
The asset management group then takes on those assets and they manage them and ensure that there's good cash flow, good returns for the investors through to disposition.
So aren't we already leased up there?
Then you've got the fund management team that looks at the fund investments as a whole. And then the capital markets team, they truly are the liaison between the investors and PEG's various investment offerings.
Jason, how are you? We also utilize the teams that we have internally. So we would go to our property management team and say, what could you operate this property at? We go to our construction team and say, what would it cost us to build this project? We also go to our development team and understand what's the entitlement risk here if there's entitlement risk. So we combine the expertise of all these teams to create a holistic project that minimizes risk for the investor.
And that one's more of a long-term strategy of really just refi, coupon clipping.
Love it.
Okay.
As an investor, you're basically a partner with those with whom you invest. And the thing that makes the difference with PEG is they honor that and respect that relationship.
Investors should expect full access to the investment team. They should be able to expect transparency around their returns. We want to ensure that they understand what's going on based on the different market drivers.
We work with our property managers and the regional managers to make sure that they understand the fixed costs of an asset like real estate taxes and insurance, as well as the debt structure. Because it's really important that as our eyes and ears and hands at the property, they understand the cash flow needs to cover these fixed costs.
Anytime something changes, anytime there's an adjustment or a shift, opportunities become apparent. How we navigate that and how we think about that will be impactful for us over the next few years.
I think it's been probably 10 years now. We've had great success with PEG, so we double down with PEG. We get diversity across the asset within PEG, and they've proven to honor that trust and respect that trust, and that's one of their hallmarks, I think.
I love how my hair changes over the years. Okay, so thank you, Dr. Wright. That was great. And actually, we did try to get his slides and things to say, and he wouldn't. So he is actually right. His reputation matters more. And so thank you so much. I really appreciate that. So moving on to our next, I'm super excited to be introducing our next speaker. She comes to us from Dallas. She will be speaking on leveraging data to see the big picture in multifamily. Kimberly Byram is a managing principal for Zonda Advisory. She has worked extensively with all real estate functions throughout the United States and Canada, including development, acquisitions, property management, and asset management. She's particularly focused on multifamily. She oversees a team of 10 consultants advising clients, actually a lot of advising clients like a PEG. She regularly presents to audiences issues related to the economy and multifamily housing markets. She has been the guest on several real estate podcasts, has also been on Bloomberg. When I asked her about something fun about herself, she did say she was a third-generation Texan. And then I said, oh, that reminds me of the Elizabeth Taylor movie, Giant, by Edna Ferber. So here's our own resident Elizabeth Taylor.
Texan.
Anyway, thank you so much, Kimberly,
Texan.
for joining.
So thank you so much for having me. I'm so excited to be here, and I'm going to say, I don't say anything quickly, so I'm going to try to talk fast, but I am from Texas. So I also want to thank Cameron and Garrett, because I've been able to spend the last 24 hours with this team, and I actually knew Deborah from before, so that's great. And I have to tell you, they have assembled an amazing, genuine, authentic team who's excited about executing. And that's been really fun to just kind of be a part of that. So thank you so much. So we've been flying at 30,000 feet with Ian, and now we're going to get down to 10. But most of the work that I do really is at Main and Main, and I know that's what you care about most. And so if you want to grab me at the break and talk about a specific market, I may have an opinion, or we can talk, the street, all the way down to the street. So glad to do that. But today we're going to fly at 10,000 from that 30 that we've been at. I want to talk about the state of the capital markets. The video that we talked about earlier talks about the disruption. So I want to bring that down into multifamily and kind of what we're seeing there. Talk a little bit about the economy, again, from the perspective of multifamily. I want to quantify, we read a lot about the housing shortage. I want to give you some background on that. talk about where we think multifamily is headed in the next 2 years, and then I know you guys are getting into the BTR space, as is everyone, and so we are collecting data and studying that first cycle of deals, and now we're in the second, so I'll share a little bit of information about that. So quickly, the state of the capital markets. So I want to talk about the series of events that has occurred that Ian already so eloquently presented, and how that relates to declining property values in multifamily. And I want to put data to it. So obviously, the benchmark borrowing rate, one of those is SOFR. So I want to show you, this actually begins pre-pandemic or right around the pandemic. You can see we went through this period of free money, basically, and when the Fed embarked on their inflation-fighting federal funds rate increases that began a 15-month or 16-month consecutive increase in the SOFR overnight rate. You can see that from January to, I believe it's June, we hit 4%, so almost 0 to 4%, and then 6 months later we hit 5%, and we have stayed at 5%, and Ian suggests we're probably going to stay there, and his data suggests that. So rapid is the word that I would take away from this, and I'll tell you what happened at my desk, in my seat, was I was working 100% fast as we can go, working on new developments, looking at deals, and the phone stopped ringing at about August, and everybody took a vacation. And I did start hearing from them again in September, and I will tell you today that there are a lot of people that are getting excited again, and they've started to adjust. This is another 10-year treasury, and you've seen these charts in Ian's presentation. I love to go back to 1990 because it basically illustrates my career. I've been doing this since 1991. And by the way, I am an Aggie, so I always use orange as bad. So 5% is bad, and that's orange. So you can see the line there is my little propaganda against the Longhorns, which, by the way, my 17-year-old wants to go there. So we have that. So anyway, the 10-year treasury. A couple things, and we have some young kids in the office, in the audience, by the way. And I want to say, if you have been practicing real estate since 2012 to 2019, you have been in la-la land. I call that the macro stable period, where jobs were going great, supply and demand was in balance. We'd come out of the great financial crisis. We hadn't built enough units, and so it's just great fine times. And you can see here that the 10-year treasury is bumping around in that 2 to 3% range. Great for us. Cap rate's a little over 6, kind of coming down to the mid-5s. Great times. The pandemic hits. And I was laughing with Ian earlier, and I said, in economics class, when they talk about exogenous factors and they start talking about pandemic, you know, your eyes glaze over going, well, that never happens. Well, yeah, now it does. So now we know what to do or not to do when that happens again. But you can see that we went all the way down to that free money, like I just presented earlier, and then up. The 10-year treasury literally is an up and down every day. And that volatility index, I think, is a great measurement of that. But, you know, we'd like to not see that hit 5. We'd like to see that come down back into the 3s. It looks like Ian's suggesting it may not. It may stay in that 4% range. So we'll see. Overall, so what did that do? I mentioned my phone stopped ringing. Well, you can see that investment sales came to pretty much a screeching halt, depending on what market you're in. So kind of going back into that 21, 22 time period, that COVID spike, everybody went out on that free money and started buying good deals and drove the cap rates down in some markets to 3% or sub 4%. So those people, of course, bought on that money and are now, and I believe later when we talk about opportunities for multifamily, we're going to talk about that wall of debt and some opportunities there. But the people that bought during that time period, it's time to start paying the bank. And so we'll see how that goes. The other chart on this slide I like to show, I love to think about things during those different cycles. So you can see how transactions went down during the dot-com, how transactions went down during the great financial crisis, and how they peaked up and kind of that historic boom period, 2012 to 2019, kind of settled in. And we're right around, we're lower than that, but we're kind of moving back up. I think we're going to see more transactions start to occur latter half of the year. So cap rates. So this is where I believe this is 2008 coming down. The inflection point was 2002, or 2022, excuse me, and we are coming back up. That, of course, impacts property values. So returns. This is a really important slide for a couple of reasons. This is the NACREIF overall total annual apartment return, and they actually track this on a quarterly basis, but this is an average of the annual returns. The 20-year history for apartments is 8%. This is on unlevered. A really important point that I was reflecting on this slide last night, and I shared, was 2000. You notice that we actually hit double digits in that, again, that happy period, 2012 to 2015. And I thought, why is that? I was talking to a broker last night, and he said, well, that's everybody that bought something right during the financial crisis and was able to harvest those returns. So that's what those double-digit returns are, so that makes a lot of sense to me. Right now we're sitting at about a 7% decline in property values, again, driven by mostly the capital appreciation, not the income side. The income has been doing well, is kind of estimated to be flat. Comparing that to Green Street data, which is -8, so kind of that 7 or 8 period. This is important as we talk about kind of what seat you are in. So depending on where you are, you may have a different outlook on things. So this is just an overall market participant interviews that I do because I love my job. Every day I get to talk to people and see what they're up to. And so if you're a fund manager or an appraiser, you're really looking at those returns because you've got to figure out how to write down your assets. And what I've been hearing from appraisers in general is that they're really using that NACREIF as a guide. So if NACREIF says that the values have gone down 5%, they're focused on that. They're really looking at implied cap rates and trying to underwrite to around 5. Acquisitions, if you are in acquisition mode, this is the great repricing. I think we'll call this period the great repricing later. But I think most importantly, and brokers are telling me, if you are going to be the buyer that gets picked, you are going to be in that negative leverage for at least 12 to 18 months. So I think that's an important metric, and again, from market participants. And then finally, development, that's my core. It's a lot of what you guys do here at PEG. The deals aren't penciling right now. We're trying to make those returns hit 150 basis points between cap and yield. That would be in that 6.5–7% range. What we really need to happen right now is for construction costs to come down. But if you're underwriting rents, you need a good third party. We talk to equity all the time. They are asking hard questions. And so I'm constantly updating my underwriting, updating my data to be able to respond to really smart people who want to do deals but want to understand every aspect of the transaction. So the economy. Already talked about this, but want to talk about this in terms of multifamily, because for us, and Deborah's over here shaking her head, jobs are king. If jobs are being created, we are building apartments and we are absorbing apartments because people are doing well. You can see again for the kids in the room, look at that stable period. Job growth at the U.S. level between 1.5% to 2% during that la-la land time. Of course, we hit COVID shock coming back. We are running at about 1.8 right now. If you trend that out, adding in that 175 that we got last month, that would suggest that we end the year at 1.5%. Overall, we think that next year will be 0.8, and that's a consensus. And then this is the soft landing that we don't really know where we're headed, but 0.8 and 0.4. This is important because this is what's built into my assumptions. This is important too. I like to look at this measurement. This is the conference board, and this talks about how people are feeling right now. And for our residents, we want to know how they're feeling. So that dark blue line is how I feel about right now. So I feel pretty good right now. I'm probably going to take a vacation, maybe another European trip this year. But how do I feel about the future is that light blue line. And you can see it's been bumping up and down pretty much with the 10-year Treasury. But people are feeling less confident about their jobs right now. So they're going to stay put. And that's important, especially for our operations currently, is the renewal activity we think is going to really continue to stay strong. Talk a little bit about this. This is the framework for everything that we do in multifamily, and this is demographics. This is the age of the population in the United States as of 2023. Zonda's research says that the median age of a home buyer right now is 36 years old. For your first home, you are now 36 years old when you buy it. That is almost out of reach for many people. And you can see that next wave, that younger group of millennials, they're actually 60% renters. The older millennials have been able to buy a homeowner at that 38%. So we're looking at 16 years of the age cohorts. Our runway is 16 years of people in each age group, over 4 to 4.5 million people that are coming that are in prime renter age. And so we really want to take advantage of that. really quickly, you read the newspaper, you see the news, you watch the news, and you hear about the housing shortage. So what I did is I did a summary of every report that I could find that talks about the housing shortage. You can see there are a wide range of opinions on this, all the way down from 1.5 million to as high and alarming as 7 million. Somewhere in that, I think we're going to present data later that shows kind of that 3% or 3 million from CBRE, but overall, we all can agree there's a housing shortage. National Multi-Housing Council has actually done the calculations for apartments and 5+ apartments, and this is really what I've been hearing my whole career, which is we need about 400,000 units each year just to keep the housing supply in balance. So that's not new, between 300 and 400. So remember that number because we're going to talk about pipeline now. So here's where pipeline is. It's declining. When you start reading the paper here over the next 6 months, that's going to be the big news. Starts are going down, starts are going down, starts are going down, and that's good, and we know that. What a lot of my clients are saying to me is, Kimberly, tell me where the gap is. Where should I be delivering now? What quarter should I be delivering now in order to take advantage of this? So I want to show that. This is if you don't remember anything else I said, this is the slide. This is the gap. This is the gap by my interpretation. So I took starts, and I've rolled those out, and I've looked at where the waves are. So right now we're in a wave, and Deborah's going to talk about that later. We're hitting a supply wave. We're seeing that in most markets. We're going to have another wave right after the election, first quarter of 2025. After that, we start to fall pretty dramatically, and we'll continue that fall. We will be below our 400,000 watermark by the end of 2026, I believe. Yes, looking up there. What that means is I'm 32 months out if I start working on a project tomorrow to deliver, and I would deliver past that gap. So where do I think occupancy and rent growth are going? And I'm going to go through this really quick. I think based on the job numbers that are being presented currently in our soft landing scenario with that 0.8 jobs in 2025 and that 2026, I think we will nationally fall below 93%. And we will bump back up, and that is, I think that as the pipeline comes through and the job growth slows, we will definitely see national occupancy be stressed a bit. So what does that mean for rent growth? We will see some rent adjustment. I think this will help our inflation problem, because if you see how fast rents went up in 2022, we do need to see some of that relief in the CPE, so I think that will definitely help our inflation problem, but we do think that we will see a couple of years of flat or negative rent growth overall at the national level. So what does that mean for operations? This is one of my favorite charts, or one of the things I learned the most during the pandemic. If you look at during, again, that stable period I like to talk about, our average renewal rate was about 52%. During the GFC, I have that on there, when people started losing jobs, people started moving out of apartments, 47%. So if the soft landing doesn't happen and something really, really happens in the economy and jobs go south and go negative, we could expect people to start moving out, right? But where are we at right now? During COVID, we had the highest renewals that we've ever seen. And we're still tracking that. And I go back to that conference board chart that I was talking about earlier. People aren't feeling good right now. They're like, yeah, I think I'm not going to buy a new car this year. Yeah, I think I'm going to wait. Maybe I'm not going to move. So as we're going through in that operations day-to-day, main and main, let's keep this in mind that we want to renew people. They don't want to move. They don't want to make decisions right now. And they can't afford to buy a home. This is really important. Again, how do renewals impact our rent roll? And so I want to spend a minute on this. The green bar is the researcher answer to rent growth. So I called a property today and I found out what their rents were, and I call them 30 days later and I find out what their rents are, and what's the change? That's the researcher answer. And that's the one that you'll see when CoStar reports or RealPage or whatever report that you look at. But then there are renewals. And I think this is a really key important part of our rent roll, right? If you look at even during the great financial crisis, we had positive rent growth on our renewals. And so that is the opportunity, again, for the current execution on your portfolio, is that renewal activity. And you can see the lease trade out, and we're going to see some negative on the lease trade out because we did so well during COVID. We've renewed people at very high rates. So anybody that moves into that unit, if it's vacated, is going to be paying a lower rate than the person that was living there prior. So we really want to protect our rent rolls by keeping those renewals up. Again, this just shows you, I took each of these markets, this is at a market level, and I did the math. So I said, okay, the researcher answer is that effective rent growth. Austin's a great example. It's the poster child right now for too much supply. So if you pick up the newspaper and you read or you look at a CoStar report, it's going to say that Austin has a negative 6% year-over-year rent growth. But if you take into account the lease trade out, the renewal overall, it's more like 3. So if you're an owner in Austin right now, you're probably more at a 3% rent loss on your overall rent roll than you are a 6. So we need to take into account that behind the curtain data. So back to the pipeline. So this is, again, what my clients ask me every day. What is the best time to deliver? When should I be delivering? So I'm showing you the gap, that quarter where I say the pipeline is going to fall off the cliff. And if I'm doing a garden style deal and it takes me 9 months of pre-development and I start last week, I will be delivering after the gap. So if you're in the market generally at the national level and you're doing these different product types, by the way, BTR it is harder to execute on cottage style. The townhome and the municipalities understand that a little bit better, so you can get it to market a little faster. So that one is right at the gap. The horizontal apartment is after the gap, and of course a tower takes a long time to come to fruition. So, and I actually have 12 months of pre-development, which is probably being kind on a tower. So these are the markets. This is Kimberly's opinion of what are the markets, if I was working today, where would I be spending my time? Well, the first place I'd be spending my time are on the all clears. If you start right now, whenever you get delivered, of course, California is a really hard place to develop, so it takes even longer. But some of these markets, go for it. Start the work, start looking. The ones in the middle, give it a quarter or two, and again, that gap, we're going to be there. And then the ones that are hold for now, I probably want 3 quarters on those. I mean, I don't hate any of these markets. These are all markets that are active that I love, where there's great, background. We've got the 16 years of runway on the renters. We just need to figure out what submarkets they're coming into, et cetera. But I would be holding for now and planning that delivery 3 or 4 more quarters out. But there are still submarkets to avoid, and this is that simple math that says here's the total number of units that are under construction in a market divided, and this is submarkets, divided by the units in the market. So big takeaway here is the West Valley of Phoenix is doubling itself. And that was desert, and now it's not. And so that is a market that's building and delivering. They also have a lot of BTR. It was kind of where the birth of BTR was. But places like Dallas, which are in my list of let's get going, I would want to have a good story about Allen and McKinney, about Frisco. Again, those are the great growth areas, but you want to make sure that you've got the right site selection, the right opportunity next to the mixed use, et cetera. Anything else I'm probably not even that worried about. There's some pockets in Denver where there's a lot of pipeline. A lot of that is more urban in nature. So anyway, there's a lot. I hate to say no to anything because there's always a good story if you can find it, and good real estate people always do. And so, we want to underwrite those, but understand what the risk might be. So, build to rent. Let's talk a little bit about that. It is becoming an asset class. Most recently, Deloitte released a survey where they ask investors every year, what do you think the best opportunity is for the next 12 to 18 months? And build to rent went from like number 7 to number 2. So that's becoming a very interesting part of the market. And I go back to that demographic chart. I think it's a great product for that millennial that can't buy a house. It is perfect for them. You also see the other side of that demographic. You've got the oldest Gen Xers that are becoming empty nesters, and some of the baby boomers that we'd really like to get out of their existing homes so that we could unfreeze the housing market. So there's a lot of opportunity, a lot of different demographic bases there that this product appeals to. But it's still very fragmented. It was created out of a fragmented industry, and it's still very fragmented. When I get on the phone with someone that wants to do BTR, I have to qualify them on what exactly they're planning to do, because it could be horizontal apartments, it could be townhomes, it could be a hybrid of some of each. So, really want to understand that. But overall, if you look at the BTR markets, in most of the active BTR markets currently, the price of a median home is much greater than renting a 2-bedroom apartment. Nationally, it's 82% more expensive to own a home than it is to rent an apartment. So this is key. This is really helpful. This gives you some of the ideas of the markets that BTR is becoming interesting in. This is the deliveries. So Phoenix is, again, kind of the hotbed for it. You do see Sarasota is a market where we're starting to see some of that, some of the Florida markets. I will tell you, the guys that come from Phoenix and come to Texas and Florida, they have a really rude awakening when they see taxes and insurance because they're not used to that. So they're trying to re-underwrite some things that they weren't familiar with. Of course, Dallas is a very large market, so we see a lot of BTR coming in that space. Again, lots of different ways that BTR is being done. Overall, in some markets, it's becoming about 10% of the pipeline. And so we're following it, we're watching it. It is an interesting segment that is becoming much more of an asset class. So what is the average rent in a BTR? This is overall data from what Zonda is tracking. You can see that it's pretty affordable. $2,000 to $2,500 is kind of the range of pricing. So again, if you are a millennial making between $72,000 and $90,000 a year, that's right in your sweet spot of what you would like to spend in terms of, you know, being qualified to live in the community. You would have a yard, maybe a garage, maybe not, depending on what type of BTR. No one above you, no one beside you. So it is a nice, opportunity for that particular housing option. And finally, just want to end and give you back some time, Allie. Declining valuations will present opportunities, and I believe that we're going to talk about that later in the multifamily opportunity. I have my fingers crossed, Ian, that you are right, and this is what a soft landing feels like because it's so weird. We're just not sure. We've talked about the housing shortage. It's real. It's there, depending on what number you believe, but it is there. Renewals. Deborah, all over it. She's going to be on it. No surprises that we will see some slowing in rent growth, and possibly didn't talk about concessions, but we will see concessions during this lease-up time period. And then again, I think that BTR asset class is really interesting to watch and to learn from. And after this first wave has come in, I think that a lot of the groups are learning that it is a rental asset class, not a single-family home, and that the multifamily operators are very well qualified to operate the product. So, Rachel.
Thank you, Kimberly. Thank you so much. Okay, so we're going to have a quick little break. We're going to give you a chance to stretch your legs a bit, bio breaks, those kinds of things. There are restrooms outside when you first checked in, and I believe the majority of them are there, and there's some, I think, downstairs. There should be some more food and drinks and whatnot. And then when you come back, so you'll hear some chimes, but 9:45 is when we're going to be back here again. We're going to continue on with our theme. You're going to be watching some videos. You'll probably notice that each video is highlighting one of our verticals. So anyway, just to kind of reemphasize that. And yeah, let's see you back, everyone.
We good? Does it look fine? Okay.
Okay, let's start this meeting, everyone. Bio break is over. Okay, everybody, let's get seated. Grab your trail mix. Natasha, can you get the people from outside to come in? Okay, thank you everybody, appreciate it. By the way, for the women, downstairs bathrooms, super warm and nice, so I highly recommend. And there's like 6 stalls, so. Okay, so super excited to get started for our next phase of the meeting. We had more of an external macro presentation by our 2 speakers, so just want to thank again Dr. Wright and Kimberly for joining us. Before we kind of get into this next section, I wanted to kind of do a call out. Nate Dallin, did you bring your kids? Where are you? Okay, can the kids stand up? This is our youngest group, am I right? You guys are in high school? Okay, so Nate Dallin is one of our investors, and his kids, I think they have some sort of program where they come, and so we want to welcome you. You guys got some good swag? Did you get some good peg socks too? Okay. Thank you so much for joining us. Okay, I hope you learn a lot. I also want to see who is our closest, who lives closest to this location? Investor. I know there's someone out here. Where's Dave Parker? Oh, he went out. Okay, well, Dave Parker has a cabin up here. Let's see who traveled the farthest. Who traveled the farthest to our meeting today? I have an idea, but I don't know. What do we got? Okay, you went all the way around. Okay. Where is our gentleman from Switzerland? Where are you, Andreas? Is he here? Oh, he's not in the room. Okay, well, we do have someone that came all the way from Switzerland. So, PEG is growing. It's growing, and we're starting to see interest from around the world. So, more to come on that. Anyway, thank you all for joining. So, I am super excited to present this next part of our program. I know that you have heard and had a brief introduction from Garrett, but we are really going to sit down with our new 2 co-chief executive officers, Cameron Gunter and Garrett Bjorkman. Most of you know Cameron, but Cameron had started this company in 2003 on his very own with Rob Fetzer and Robert Schmidt, and I think you kind of know the history there. It is now one of the fastest growing commercial real estate investment firms in the region. Cameron was born, raised on a farm, and he acts like it, and he is the first to be in the office and oftentimes the last. And he is it's insane. He's got outside the box thinking, very creative. Someone even just mentioned his lawnmower video. So yes, very creative. He's a CPA by trade. Most of you probably don't know that. And anyway, he's grown PEG to be now a $2.7 billion AUM company. Cameron has been wanting to grow the company. We've decided to go this investment, really focus on that, and so they'll tell you more of the story, but I wanted to share with you a little bit about Garrett Bjorkman. He is now 3 weeks in So a veteran, not by any standards, but he really has been brought in to help expand the investment vision and products and pipeline for PEG. Garrett brings with him a wealth of highly relevant experience to PEG. He was previously 9 years at the CIM group based in Los Angeles. He was a managing director and portfolio manager. He managed a team that launched CIM's credit platform and grew assets in that one particular platform to over 10 billion in AUM. He's also responsible for launching and overseeing CIM's build-to-core equity development strategy, which was a $2.5 billion strategy. So he has had several positions that make him absolutely well-poised and perfect for what we need to do to help better manage and just to continue to grow our investors' assets. So we're going to have this with our very astute Ali Monson. I was a fangirl of hers before she joined PEG. She's been on TV and I think Good Morning something, or Good Morning Utah. Yes, there we go. Okay, so I fangirled her before she even joined. So she's going to be moderating. So without further ado, let's have our co-CEOs led by the very astute Ali Monson.
Thank you, Rachel. I appreciate that. That was overly generous for me, not necessarily for them, but I am so excited to be able to sit down today with all of you, and of course Kim and Garrett with you guys as well. And I think this is really exciting. This is a bit of a historic moment for us as the two of you sort of sit down together publicly as co-CEOs, and I think it's natural, right? There are going to be a lot of questions about what this looks like and what an arrangement such as co-CEOs how that all will happen. So I'm excited. I think this will be a very open, transparent conversation. We all love and adore Cameron. Rachel mentioned, like, he's a farmer, he acts like it, he's transparent, sometimes overly transparent. We like to joke internally. But no, we adore Cameron for that. And it's been fun. It's been fun as a fly on the wall, as a team member and an employee of PEG, to watch Garrett sort of come in and the two of you hit the ground running with this. So I look forward to what should be a very open, honest, and informative conversation today, not only about PEG today, but also PEG of the future as we look ahead. Let's start with some background, Kim. I want to start with you because it's no secret that for quite some time you have been searching, right, for the right person to really lead the charge for PEG Capital Partners. Why did you see that as a critical next step for PEG and our mission and our vision moving forward?
Well, look, I heard both you and Rachel say that I grew up on a farm, I act like a farmer, so all we know how to do is plant crops and grow crops. So no, in all seriousness, it's as we've grown the company, the vision of the company of being this vertically integrated company, and as we continue to see the growth as an investment company, it made a lot of sense, and I've been looking for somebody to come in and run PEG Capital Partners that has that experience. And it just, over the last year, we really knew that we needed somebody with the skills that Garrett has to come in and drive that side of the business, and I could step back, just because we've grown. Mm-hmm. It's much easier when you're smaller to be able to do a lot more. But as we've grown and we've added funds, we added different investments, it was very important for us to add somebody that has that experience. One of the things, and this will be quick, but as we introduced Garrett to the company, I knew he plays the banjo, and there's not many people that know how to play the banjo. So
it's unique, for sure.
Garrett really plays it well, and so I said, Garrett, look, this will be really kind of cool to show your experience versus my experience. So he taught me a few little chords, a little picks, whatever.
He tried to teach you. Let's be clear. Yes. He tried to teach you.
So I was able to play probably 2 or 3 notes, but it was just ding, 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 something like that. And then we had Garrett play, and he could really pick and fill.
Garrett rocked out.
It's not every day that your first day on the job, that your introduction to the company is, hey, can you play the banjo, right?
Like,
okay.
We're super interested in all of your qualified expertise, but can you just entertain us for 3 minutes, please?
So, I mean, that's a good parable, I would say, of what we're doing, is bringing somebody that knows what they're doing. We can try to go figure it out, but having somebody in like Garrett to run the investment side of the business will make all of us a much better company and really execute on the vision and the mission of the company.
For sure, with strengths that complement one another. I know that you were looking for someone who was highly specialized, right, and qualified for this role. So how did you actually become acquainted with Garrett? Can you share that story? It's kind of unique.
Yeah, Jay Rollins said it's a long shot. We won.
A board
The
member.
long shot made it. So Jay Rollins is a board member, and we brought him on the board in 2018 when we made the decision to really jump into the investment world and be a better investment company. And so I was sitting down with Jay prior to the November board meeting and say, look, I have to get something put into place. We're dealing with a lot of issues that we need help with. And so Jay said, look, here, I know this guy. He worked for me, told me the story about Garrett, of him being his receptionist. And I hope you didn't want me to tell that. But Jay said, hey, he was my receptionist. He was a kid with a master's degree.
That was a long time ago. Yeah.
And I'm going, gosh, that guy must know how to work. And anyway, we ended up meeting Garrett, and were able to structure something, and very impressed with Garrett. And we're excited to have him.
Garrett, what were your thoughts at the time? I mean, you have your former boss, right? This former acquaintance making an introduction, and you're comfortable, right? You're in a highly impactful position and role at CIM Group. So what was it about PEG that caught your attention?
Yeah, I mean, look, Jay, pressure's on now for Jay. But no, look, I had always stayed very close to Jay since, working with him at JCR, and then after being at CIM. And, we just always stayed close, and he called me one day for breakfast and said, hey, meet me at the Valley Ho, I want to talk to you about something. And he had this piece of paper in total Jay fashion. He's like known in the industry for like putting term sheets on napkins and getting deals done and stuff like that.
It's chicken scratch, so we can show you, but you may not understand it.
But he said, go out to Provo, just meet this guy Cam, and just talk to him. And wasn't looking. I was in conversations, at CIM, where I was in a great seat. I was managing $13 billion, and I was in a great spot. But I think I flew out here. It was like Christmas Eve or maybe the day before, and sat down with Cam and started talking about what he had built over with the rest of the team over the past 23 years, and kind of it was so clear to me that what Cam and the team had built was something that was very familiar to me, because at CIM we were a vertically integrated asset manager with development, property management, capital markets, hospitality management, etc. And I was able to really put together products there in a way that utilized a lot of the competitive advantages of the firm, and was able to scale the business in a way that delivered exceptional returns to those investors, and grow and prove out a track record, and amass a lot of money. And when I looked at what Cam had, I said, oh my gosh, all of the pieces are here. All of the business components are really operating really effectively, and Cam had a commitment to excellence that I saw and had that same vision for, and said, if we can really have that commitment to excellence to make sure that every one of these operating companies is committed to excellence, and if at the end of the day our end investor is truly the main focus of every single one of these companies, then there's no reason. I see an absolute clear path for massive growth and opportunity. So that was the story.
I like that story. I'm seeing parallels with my own story too. I like that you went to breakfast, because it was a very similar circumstance with Mark Bingham, who many of you know, where we went to breakfast. I was in TV at the time, and he pulled me over to PEG. So I'm seeing patterns for sure. It's very cool. But I think, as a fly on the wall, as I can sort of speak from an internal perspective, from employees' standpoints, we were all sort of expecting a change. We knew it was coming. We knew it was on the horizon. We knew we were bringing someone in. I don't know that everyone was expecting the title co-CEO. And so can you share sort of how the evolution to that specific role came about, Garrett?
Yeah, so, you know, look, it definitely wasn't where we started, but it was a very, honestly, the conversation was very organic, and it took a long time. And then, honestly, the goal, I think, was always, like, neither of us are doing anything unless we both think that it's perfect. And what perfect meant to us at the end of the day was a structure where we felt that incentives were aligned across the entire company, where we were all incentivized, and by us all, I mean everyone at PEG companies, is incentivized to generate the best returns for the investors. And so I think when we started looking at PEG Capital Partners in isolation, it was kind of maybe a more historical looking view of how PEG saw itself. But, you know, Cam had already taken a lot of the steps to roll the company up into one company. You know, before it used to be PEG Development, PEG Property Management, PEG Hospitality Group, and I think at the end of the day, Cam realized on his own, hey, at the end of everything's about the investor. And so we need everything to roll up into one entity. And so I think that's really the genesis, and that alignment of interest with our investors is why that title came about.
That's great. Okay, let's talk logistics just for a moment. You know, I think the obvious question that arises when you hear about co-CEOs is what does this look like? You know, how is this actually going to work? And so we won't spend too much time on this, but I do have an org chart. And Cameron, I would just love for you to sort of speak to how the two of you have divided out the roles and responsibilities and why.
Yeah, I think that, you know, Garrett talked a little bit about the roll-up and how we're vertically integrated, and as we grow and as we have grown, it really makes sense for us to divide that out. And with my background more on the operations side of the company and how we started the company, it made a lot more sense for me then to take and focus on the operating side of the company and have Garrett really focus on managing our current assets, current books, and really creating new investment vehicles to take advantage of some of the opportunities. But it was very critical for that to happen and to be able to divide that out. One of the mission of the company is we talk about driving to the best return on the investment, which includes really three pillars at PEG, and that is the investors, and our team members, and our tenants, residents, and guests. And I will take and I'll focus heavily on the operations side, so we can drive to that return for those investments on the operations side.
Okay. You know, I want to talk for a moment about areas of focus, first in the near term, and then we'll get into some of the future opportunities. But first and foremost, I think we have to discuss our current book, right? We've heard throughout the morning so far about some of the challenges of today's environment. No one is immune to these challenges, including PEG. So Garrett, I mean, what is happening right now at PEG to really sort of dive in, evaluate, and execute on PEG's current strategies?
Yeah, so, you know, look, I've been here now 3 weeks.
No pressure.
In that time I have, you know, look, my first focus was sitting with every portfolio manager, going through every single portfolio, understanding every asset, understanding what is the, you know, kind of next juncture, the next decision point. What are the upcoming risks? What does the liquidity situation look like with respect to every deal, and really risk ranking each asset and each fund, and starting to come up with a real plan on what are next steps. And I would say what I was very pleased with is that, you know, I was incredibly pleased with the people that we have and the plans that were already in place, and people had really been thinking about what are next steps. And I think just generally looking at the portfolio, the conservative way that we've levered
and the capital markets relationships that we have, and I really do believe with just the team that we have today, we are in a position to really get through this and deliver on what we've targeted to deliver to investors. Now, it's not going to be without hard work. Given the backdrop of what everybody's, Kimberly and Ian have gone through this morning, there is a lot of work to do. And so I'm not going to sit here and say, hey, we went through the book and everything's easy. That's not the case, but I'm incredibly pleased with the talent we have, the people we have, and we're going to be spending a lot of time and focus on, and I think especially in this new role with Cam being able to focus more on operations, really focusing on driving those property operations and driving returns.
Yeah, I'm starting to see sort of how this is all coming together and how each area will have better oversight probably with this arrangement. Cameron, I want to talk operations for a moment. Obviously our theme today, PEG360, as in vertical integration, right? Being able to manage the entire life cycle of every investment. And with operations specifically, right? I think there's a lot we can do. There's opportunities out there. I know this is something you're really passionate about. How do you plan over the next several years to further enhance what we're doing at the ground level at our properties?
Yeah, you'll hear a little bit later today about a couple of buzzwords. One of it is a customer journey on the operations side, whether that's a customer, one of our tenants in our residential multifamily units, or it's a guest that comes and stays at one of our properties, and you'll hear this idea of a curated experience. And as we saw from Kimberly's slide about that 16 years of that millennial and Gen Z renters and travelers and all those people, they want that experience. They want that curated experience, and so we're going to work on creating that experience. You'll hear, a little bit later about some other stuff that we'll be doing, but I think it's super important for us at the property level to understand and be able to act quickly. And so part of doing that is being able to use technology, use data for that property manager, somebody at the property. We're going to do something different than what we've done in the past. We're doing a little bit now, but we're going to get more to where decisions can be made quicker at the property level so we can return the investment and we can have a better experience to our customers, both from the investor side and the tenant resident guest side.
Yeah,
and
those
so,
end users.
and our team members, right? Our team members will want to be part of something big, right? And that's, I think, what's really important, if they can get engaged and really be part of a company and part of a vision that's something bigger. That's what drives you. That's how we win, is being able to get into that and understand how we can improve that property to improve the investment return.
Absolutely. I think you guys are spot on with this whole experiential real estate concept. I read something, I thought it was really interesting. According to Salesforce recent data, the experiential factor, right, whatever that means, has become the key brand differentiator, even they say above product and price in the consumer industry. And so, Cameron, it sounds like you're seeing parallels. I mean, it sounds like this is something you're passionate about with our property management and even development as we look at properties and how we structure and create those experiences.
Yeah, so you look at what we've done. We've built over the last 5 years, we've built these projects between student housing, our apartments, our hotels. We've really thought about that curated experience, even with our obvious, our clubhouses and what we're creating there. We will refine that, and as part of that refinement, we're going to come out with our own brand.
Oh, I love that you just dropped that. That was under
Yeah,
wraps.
it's a, we feel like we need to on the multifamily side.
For sure.
We're in the hotel business, and the hotels are driven by brand, and that's where they get the experience. And so as we look at this curated experience, we look at health and wellness, we look at just the way a project or a multifamily project is built and the lights in it. There's some really cool things that I'm probably
No.
still in your thunder
I
because
love it.
you're behind a lot of this, but it's really cool to think about what we can create with that experience with this new renter and the longevity of the renters coming into the multifamily space.
Yeah, you can see the passion behind it. I think what we're trying to do with this new multifamily brand, which you'll hear more about in coming weeks and months, but essentially is not just create that property, right? But to create a community of like-minded people, right? Who prioritize wellness and self-care and all of those things that they also want to surround themselves with their neighbors and such. And so I think you're right. I think this has longevity. The concept of wellness doesn't go out of style. And so I'm really excited to share more with everyone over the next couple of weeks. But next, I do want to move into opportunities now, and as we look a little bit further on into the future, I think that's a good segue. So Garrett, we've heard so much about these debt maturities that are going to be coming due, and I do want to point out that Cameron's timing could not have been better in terms of bringing you over. Cameron, I know that was strategic and intentional, but Garrett, handling debt is one of your greatest hallmarks. I mean, at CIM, you were responsible for the first time, launching their entire credit platform, and it was highly successful, growing assets under management by how much did you say?
A little over $10 billion.
$10 billion. This is not your first rodeo. How did you do that?
So I mentioned it a little bit before, but I think it was, at CIM we had some of the same DNA that PEG had, in particular in the development space. And so when I went over, I saw that there was clearly a void in the debt markets. There was a lot of capital moving into private debt. There was a clear market opportunity that most of your big, private equity sponsors had recognized and were forming capital in the form of mortgage REITs and private funds. But there are very few that actually could go out and provide loans for construction or heavy transitional assets with a capability in-house to really convince investors in a reasonable way that we could manage that risk in an effective way, and as a function of actively managing that risk, earn outsized return, because there were very few other people in the space. And we continued to build on it, and we delivered, right? And I think it was all about what we told investors, what are we going to do, and having investors see those results continue to get delivered, give people their money back. And we kept to see every time I would give somebody their money back, it would double, right? Every time it was coming back, it was double up. And so it grew very organically. So that's how it happened. And I think, we'll be taking that same kind of organic approach with how we develop products at PEG.
It's great. It's really, really exciting. Cameron, it's no secret that during the Great Recession, it was obviously a very challenging time, but some of PEG's best deals emerged out of that. So I'm curious to know, do you feel like it will be a similar narrative one day? Are there similar opportunities today that one day people might look back on, in that similar way?
Yeah, you guys don't know, I called Dr. Wright and told him to put that last slide on, because when we came out of 2010, we started to invest dollars into real estate, and those were our most successful years. And so I'm on the same page as Dr. Wright, and now's the time to invest in real estate. Real estate's a long game. You hear me always say real estate's a long game, and it depends on the debt you put on that real estate and being able to hold that real estate through the times that we're going through. And then as we talked about, operations is super important on our existing book. But we also see that as an opportunity to come into maybe some of this distressed capital stack that's out there because of the maturing debt, to step in and use our operations to be able to invest in new assets, whether on some part of the capital stack. And as it relates to development, we're a development company. We're going to continue to be a development company because we see opportunities there. On the hotel space, if you look at the supply and demand right now, you know, supply's been cut off for the last several years, and demand has just picked up. And you'll see a little bit later in some of the presentations that's a good space for us to be in, and that's what we have expertise in doing, and we'll continue to do that. And then as we look at multifamily, you saw what Kimberly was saying, and we have that strategy. We have projects right now in the pipeline that we're working through entitlements, we're working through design. We're not digging a hole right now, but there's opportunities for us when the supply turns around, we start to see rents come back, and the reset, what I call the reset of the rent market, we're going to be in a position like we were before to really take advantage of that. And it's great to have Garrett with us to help create a vehicle around how we do that. And so, and then our current staff. I mean, our current team, we grew because we were a development company. We have the right people to do that.
I know, I love it. I think throughout history, like I look at the PEG organization and how we've evolved over time. We obviously started as a development group, as a developer. And when other people turned away or shied away, PEG was tackling it. PEG was tackling those higher barrier to entry projects because we can be creative, right? We can be creative with financing or entitlements or whatever it be. And you feel that we're going to continue to do that even with the development projects. Is that what you're saying?
Yeah, that and with our current book. I
Yeah.
think that same concept comes with us to protect that and look at the future.
Okay. Before we wrap up today, we do have some investor questions that we have received. So I'll go through a couple of those. I'm not sure how many we have time for. But the first question should be right here on the screen for us. It says, we've been hearing a lot about the distress in the market. Where is it exactly? Why does it feel like we're still waiting to see the impact?
Yeah, it's a great question. Look, I'm sure those of you in the room that own assets, you're feeling it. You know, look, ever since interest rates started going up, in particular long-term interest rates, and I think as long-term interest rate expectations have continued to go up, we've seen appraisers start kicking out discount rates and exit caps every quarter. So, you know, we have seen the deterioration in values, at least on the books, start to happen in the private space. I think when you look at implied cap rates in the public markets, you're starting to see that you know, expectation for where assets should be valued in the public markets, you know, narrow with where they are in private markets when you look at the Odyssey or other kind of key, you know, core benchmarks. And so I think, you know, that narrowing of expectations with where assets are priced on people's books, combined with some of the stabilization that's happening in the 10-year, is giving people more certainty about where the future is going to head. And I think over the past couple years, there's just been so much uncertainty about where a rate's going to shake out, that banks and lenders have been willing to work with people, and people have been willing to extend liquidity into assets where they didn't know if there was going to be equity left. They didn't know if, you know, in this interest rate environment, is it still worth protecting? And I think that that's starting to change. Look, obviously office, there's been distress for a couple years, and you've been seeing people just hand back the keys. People haven't been fighting. It hasn't been, you know, in the headlines, I think, because a lot of it's been really quiet, and people have purposefully kept it quiet. And, but now, you know, you're starting to see it in multi, just given the high levels of debt that were available in 2020, 2021, when interest rates were at zero, and we had the highest, you know, levels of commercial real estate transaction in history, and now we have rates and borrowing costs that are 5 times higher. There's obviously liquidity pressures in the short term and values down. It's going to create opportunity just naturally. But so I think we are seeing it. I think we are certainly seeing it in the pipeline of new opportunities. And you know, you're going to hear from Soren later. We are certainly focused on navigating those issues as it relates to the stress that's in the market with our current book, but also how do we take advantage of the opportunities.
Okay, I think we have time for one more question. Let's look at this one for Cameron. It says, with the oversupply of multifamily units in the market, is PEG planning to shift their focus from development? We talked a little bit about this, but as a result.
Yeah, I think because we are vertically integrated and we have experience in a lot of different areas, we can shift, right? If we need to shift into acquiring assets, we can shift into acquiring assets because of who we are. But as I said before, I think there is development opportunities. It's getting stuff prepared, and especially in the hotel space, I think there's opportunities there. So one of the opportunities, to Garrett's question, is I think S-REIT has some opportunities coming out now fairly soon, right? Or having issues. Maybe that's the next opportunity, is the Starwoods run on their bank, I guess, or run on their investments.
Okay, thank you. Garrett, we have just maybe 1 or 2 minutes left. So I think what I would like to do is just give you an opportunity to talk directly to our investors. I mean, many of them are here joining us in person today, as well as on the live stream. You've been with us, gosh, what, 3 weeks now exactly, since the beginning of May. And so as we wrap up, what is it that you want them to know in terms of what's next at PEG and this next chapter of growth for us?
Yeah, I mean, look, I guess I would say, you know, look, I'm here for you. You know, Cam brought me on, and the board brought me on with really one mission, and that was to improve your experience and to improve what we do at the company to do better for you. So, you know, that's my singular focus, and you're gonna, you know, hear a little bit about it later, but in every meeting that I'm sitting down with people at the company on, it's how can we improve the experience for our investors? Our investors deliver better for you. And so, you know, I look forward to spending more time with you all, getting to know you. I look forward to your feedback on ways we can improve things we've done well. That is critical for us to be successful. And, you know, I would just say, you know, thank you for the opportunity, and I'm really excited to be a part of this.
Cameron, we've talked about this internally, but I feel like it's important to ask. The rumors are swirling. We have to mention, are you transitioning out of PEG anytime soon?
No, and the reason why is because we just brought John Stockton to the dream team. If you can't tell, we have
just a
superstar
shorter,
coming.
like 1 or 2 inches maybe, I don't know.
Maybe, but yeah, I mean, I feel like we've got the dream team here at PEG, and it's just to have Garrett come on, and many of you know I play basketball a little bit, and I like the point guard to throw me the ball because I know how to score. So
Yep.
Here we go. We got John Stockton. We're gonna
I love it. I love the
call him
analogies.
John
You
Stockton.
can always count on Cameron to give us a sports analogy, whether it's basketball, football, who knows? Probably hockey soon. I don't know. But that's what we love to hear. I can just speak again as an employee of PEG and as someone who's watched this transition happen over the last several weeks. Just that I think this works so well because the two of you really do complement each other, and it's fun to see someone with, you know, an equally passionate vision for PEG come in and tackle this with you, Cameron. And I just want to thank everybody for the time. Thank you guys for sitting down with us today, and I look forward to seeing what's in store and what happens next.
Thank you.
Thank you.
Since last year, a lot has happened here at PEG Development in spite of all the headwinds that we're facing in the economy. We've opened the Lures Moxie, we have opened Revival Apartments in downtown Salt Lake. There's been several of the extended stay conversion properties that have opened. Recently, Spring Hill Suites Scottsdale opened. We broke ground on the AC in Scottsdale. Desert Color Apartments the Tucson Bautista Apartments, the Built for Rent project in Caldwell, Idaho, and we've had a successful integration into the Nanaimo community with our Courtyard by Marriott there.
Nanaimo is a city on Vancouver Island in British Columbia. It sits on the eastern shore, about the middle of the island, and it's a growing community. And the city of Nanaimo put out an RFP years and years ago seeking development on a city-owned piece of property right next to a city-owned convention center. And they went through numerous iterations, projects that ultimately never came to fruition. So they had gone through this process for 10 years. So we looked at it, we responded to the RFP, and were selected as the developer to do a Courtyard by Marriott in Nanaimo. Early in the process, we began working with the Sunamo First Nation. This site was historically a part of their lands. It was a place where they would camp and fish and take care of their families. And so early on, we decided that it would be important to pay homage to their heritage.
Every piece of property within Nanaimo territory is sacred to our people. But our elders are very happy that we're here as partners, joined with PEG, and not standing on the outside looking in.
Good afternoon, Courtyard by Marriott, and I'm this is Kendra.
When you're building on an island, there are unique challenges. We've got labor issues, having enough people, getting materials to the island. It just adds cost, time, and complexity. And so our contractor suggested that we look at a prefabricated or panelized system for the exterior, a environmentally friendly, low waste, no waste type of a product with a very high thermal value, and something that could be completely assembled, including the finishes inside and out and the windows installed. That project started before COVID, and so we did encounter some challenges in terms of production and manufacturing. But we pivoted, we adjusted with some creativity and some willingness to stick with it. Ultimately, what was installed has turned out really well.
PEG was unbelievably open and friendly. They always took phone calls, they always reached out. Cameron himself has been on the board of directors, so it's been a great relationship. It's really allowed us to go out now and really sell Nanaimo and be competitive with those other cities such as the Whistlers, the Pentictons, the Victorias. So thank you to PEG and to their team for choosing to come to Nanaimo.
The Nanaimo project is a good example of what we're capable of as a company. It was building in Canada on an island, public-private partnership with the Sunamo Nation. We used some cutting-edge technology with the Nexi panels. All in all, I think it was a great success. We plan to leverage that creativity, that perseverance, to propel us into the next era of PEG development.
So I want to thank Garrett and Cameron for kind of dispelling rumors and for sharing with us how we chart the course forward. I have a new boss. I now report to Garrett, so we'll see how that goes. No, it's good. I'll make it easy on your promise. Okay, so also Nanaimo. I think there's some out you that I know are invested in that. It's a fabulous property, and so it's been really exciting to see that. Just a little plug for my team. The Sunamo Nation, they are the First Nation equivalent to the Native Americans in the U.S. We were raising equity for it in the middle of the pandemic. And Cameron's like, go find one of those First Nations. And so Carson Rawl, I don't know if any of you know him, he's a local here in Provo. He literally went to the internet, looked up First Nation, called Sunamo. The chief, Mike, happened to be in Vancouver the same day Cameron was. They met, and they are the largest equity investor in that hotel. So anyway, kudos to my team. So they're fabulous. Anyway, okay, so we're going to go into what I think you folks are going to be most interested in potentially, and that's discussing performance at PEG this past year, as well as what we're going to be doing moving forward. So we're going to kick off with Craig Bingham, our Chief Financial Officer. He's going to be discussing the fund performance of our different investments with all of you, or somewhat involved, somewhat invested in. So he'll be doing the fund performance review. Then Garrett Bjorkman will be standing up to kind of share with you, kind of rethinking how we're going to be investing. So he'll be commenting on what Craig had just mentioned. Then we'll go into Lauren Berkeley. He's our CIO over hospitality. He'll be sharing with you opportunities in hospitality. And then we will cap off with Soren Halliday, who is our CIO over multifamily. and conversions. And so he'll be talking about opportunities in multifamily. So just a little bit of background. I think you know most of these gentlemen, but Craig Bingham, I mean, he's our CFO. He really did bring standardization to the organization. And if you want to ask anybody anything about anything in the organization, Craig knows all answers. So just talk to Craig. I think you've heard a little bit more about Garrett. He is a fabulous banjo player. Lauren Berkeley comes to us. He came from Four Seasons originally. Then he was at Lodging Hospitality. He has extensive background in hospitality, so we're excited to hear more from him. And then Soren Halliday, I mean, come on, he's a local boy favorite. He did something at BYU football. I always forget what it was, but phenomenal friend as well. So anyway, let's turn the time over to Craig.
You there? You're good? Well, I don't know about you. Rachel maybe got one boss. I might have got two. So we'll see how that goes. Well, first of all, it's great to see all these faces out here that are familiar to me. You know, I really enjoy catching up with people. That's one thing that I really like about PEG, and it's been fun, is just the people that are involved. And we're in a people business. We have tenants, we have guests, we have investors, and we really just enjoy how do we make you happy? How do we make things better? How do we make the experience more rewarding for everyone? So first of all, I'm going to give you a little overview of how PEG does, not just fund, but we're going to talk a little bit about, you know, I can give you an overview, really our AUM and what that drives down into type asset class, how we've done in those asset classes, and we can kind of finish that up by looking at funds. So first of all, and some of you this may be a little bit of a surprise to you, but PEG is actually the largest AUM is residential. Within that, we have student housing, we have multifamily, BTR. This is our largest asset category for us, and that may be because, you know, originally back in the day when I came to PEG, we were primarily hospitality. You know, and hospitality has been a mainstay at PEG, but we actually have more money in multifamily and enjoy that asset class, and thought it's done well. The last one is other. Within other, we have a little bit of office. About 4.4% of that is office. We've never really been an office builder or developer. We primarily do it as maybe a niche thing, special circumstance, but overall, primarily multifamily and hospitality. To give you a sense of how we're doing within residential, maybe it'd be helpful to give you a little background. So PEG, when they started, we've been primarily about cash flow yield, which means we tend to hold our assets longer, try to maximize our MOIC, which tends to drag the IRR down a little bit as you hold assets longer. So you can see here, really in the residential, and maybe another thing, give you information about stabilized assets. What we're doing is excluding assets that were recently opened, they're under construction, or they're changing use, whether that's from multifamily or hospitality to multifamily. We don't include those in this stabilized category, just to give you a sense of how they are doing. And from a valuation, maybe it's helpful to give you valuation knowledge. So we have a valuation policy, and what that means is we look at how we're valuing all of our assets, and we take PwC, market information, market transactions, and we take all that data and try to determine what our assets worth and what would we sell those for. And we take all that and basically come up with IRRs and MOICs by looking into the future and then discounting that information back to today. So you can see generally residential we hold for around 5 years. We have MOICs that are generally in excess of 2 and IRRs that are near the 20s. This asset class, we do think that we do have some ozone assets that are in multifamily here. So we might see the average hold in future years depending on what we acquire. That might extend out and MOIC might go up, as well as IRR may drop down just because of those ozone assets as they transition through, or the effect of the hold period is washed through. Hospitality, you can see we actually hold assets longer here, which is really more akin to the fact that if you go back to when I started here back in 2013, we're primarily hospitality, and we've held those assets a lot longer, primarily to just generate cash flow yield, as many of our investors wanted that. The MOIC here, we have realized at the 2, We're kind of forecasting right now, we're about 1.5, which that's dragged down a little bit just due to some of the Fund 1 COVID challenges that we had. Finally, office. We don't list it here really because we have a lot of office, but it's I don't know if it's the bad word out there in the industry, but office is definitely a challenged asset. But you can see here, we tend to hold our assets 9 years. That's, maybe gives you a flavor of how much we actually get into office, and most of it's medical office, I would say, and low IRR percentage just due to the COVID impact and what we've seen there. All in all of PEG, as from a realized, we've had about a 15.7 with a 2.2 MOIC and about a 6-year hold. This gives you a good sense of how we've done with your money. One thing we're not happy with hospitality. We do see positive wins with hospitality. We do see ADR rates out there increasing. So if we have new hotels, those hotels are generally performing really well right now and a great cash flow. Lastly, give you a sense of how funds are doing. So Preqin is an industry, it's a company that is in our industry. They basically collect and anonymize data for alternative asset classes. And they use that so people can benchmark funds. And you can either benchmark it like a core plus, value add, or opportunistic categories. Fund 1 is really an opportunistic. It was a 2018 vintage. About 45% of it was in hospitality. So you can see that in order to try to get some of those returns we have, we're holding generally longer, which has pushed the MOIC up, but it's also dragged the IRR down. And you can see there the percentage gives you a sense of how we're doing within the opportunistic category within that vintage for fund. The next one, Opportunity Zone Fund. It's a little harder for this because Preqin doesn't say, oh, here's an O-Zone fund, why don't you compare against other people? So what we do is we go out and collect public data that's for other companies that are public that have funds that are in the O-Zone. And we can compare against them and see how we're doing. O-Zone has had its challenges. I mean, again, it was to build in disadvantaged neighborhoods, but generally built mostly multifamily in our O-Zone fund. We see currently a lower IRR, but outperforming what is available in the public, as well as the MOIC. And we expect this to improve over the years. Lastly, the extended stay conversion. One reason we put projected net IRR here is due to the valuation, we don't value our assets for their intended use, we value them for their current use. So that may mean, hey, if I'm going through an entitlement, I'm not going to value it as though I already have the entitlements. I'm going to value it as it sits today. So what we're doing is putting in the projected, which is, hey, this is what we expect to happen based on current underwriting, current market conditions, as those entitlements, current entitlement process and what we see happening. For this, we see roughly an 11% net IRR with a projected MOIC of 1.5. This really gives you a sense of kind of how we're doing. And if you have any questions, I mean, you can always come up and talk to me. It's interesting. I was just at a conference last month, and I was talking to a hotel developer or a hotel asset manager, and they own probably 3 times the amount of hotels that we have. And one of the things that was really surprising to me is how archaic their systems were. That's one thing we've tried to do at PEG is how do we put all our systems, how do we collect data, how do we make better decisions, how do we make them quicker to just really benefit you. But we appreciate the trust that you've given us as your fiduciary, and we don't take it lightly. Thank you.
Thanks, Craig. Good morning, everybody, and thanks again for coming. Incredibly excited to be here. So I emailed the team. It was like 2 in the morning. I wake up and I said, Natasha, scratch whatever I was doing on the presentation. This was probably a week ago. I was going to talk just about nuts and bolts, and I said, we need to address
you know, how we start rethinking how we invest. And this is not about, you know, how is PEG going to change the way that it invests going forward. It's going to be a philosophy and a practice about how does each and every one of us as a team, as an organization, continuously reevaluate the way we approach opportunities in the market and the way that we execute in a way that delivers on the returns for you and delivers to you products that you want in your portfolios and that achieve the goals that you've set for your financial success. Now, as I started thinking about the big picture and about all the things that we want to do going forward, you know, Cam and I spent a lot of time earlier talking about growth, right? And one of the things that I love about this business is, you know, you get to interact with a lot of people who are really amazing minds and people who have done amazing things in different industries. And yesterday I was having dinner with somebody across the table, and he asked me, he said, you know, he asked me about why I joined PEG, and I told him about all of the opportunities that I saw for growth, and he asked me, do you think this is a good time for PEG to grow? And I thought to myself, and I said, okay, this guy, what's the question behind the question that's being asked? And I think the question behind the question that was being asked is, isn't there enough on your plate right now that you need to focus on? Isn't there enough in front of us that we need to focus on to execute on the existing portfolio? And I think the answer is absolutely, right? And so that is where we are focused first and foremost, is on executing. And what Craig put up in the prior slides, and when we benchmark ourselves against third-party data, we're not benchmarking ourselves to make excuses to you on why we didn't deliver on the target returns that we set forth in our conversations. Look, cap rates, interest rates, they're going to be what they are. We have no control over that, right? But there is a lot that we can control. And so we are going to be doing every single thing possible to increase the things that are controllable, which you heard Cam talk earlier about. One of the things with me coming on board, and I've spent so much time with Cam, and it's been amazing, and with Rob and with Craig, we're thinking through technology, we're thinking through how do we improve the operations at all of our assets? How do we make incentives better for not just people on our investments team, but all the way down through to the general managers of our hotels and of our apartment buildings? How do we drive the right incentives to create the kind of performance that we're expecting? If we're not getting something, if we're not getting the results out of something, we have to make the hard decisions now and quickly to fix it. And so I think that's one of the things as we go through the portfolio, and what you're going to see over the next few quarters is there's going to be a consistent focus on how do we make decisions quickly, and part of that is understanding the long-term calculus, and some of these decisions are going to be hard, right? Some of these decisions are going to be hard. We do believe that you know, interest rates are going to be staying elevated for a period of time, and they're not going to be what they were a few years ago, right? And so we've accepted that, and we are not going to continue to throw good money after bad in assets that we don't think are successful. And the truth is, if we're emotionally attached to certain assets, we have to break that emotional attachment and start making rational decisions. And I'm not saying that that hasn't been happening, but I think we're at a period of time in the market where we should have the confidence to start making those decisions and making them more quickly. And I think that is going to result in the realization of some losses, and I think it's also going to allow us to focus on the assets where we really have the true ability to succeed. And I can tell you that as I am sitting down with all of the portfolio managers, with all of the operating, property division presidents, with Cam, it is what can we do to deliver the target returns that we set forth for you. So, we're never going to come to you and say, hey, Fund 1 was a bad fund because of COVID. Did COVID happen? Yeah, of course. But we are going to be working every single day to deliver on the returns that we are targeting to achieve, and we're going to work as hard as we can to make that happen. So continuing on the theme of just rethinking how we invest and how we're continuing to utilizing the PEG vertically integrated team is obviously something that I found super compelling and I shared with you before. And I think one thing that we want to make sure that everybody in this room knows is that we're going to continue offering the same types of investments that we've always offered. We're going to always try to improve on those offerings, but we're still going to have direct investments. I know a lot of you in this room are focused on doing stuff direct, want to do co-investments or not fund investors. Totally understand and appreciate that. We're going to continue to offer those opportunities for the clients who are situated to be able to do that. But we're also thinking about bigger, about what is happening in the macro world in terms of what's happening with investments. Another great mind that I always like to follow is Mark Rowan. I don't know if many of you know Mark Rowan at Apollo, but starting my career in the credit business and having spent a lot of time in credit, what Mark did at Apollo was he basically bought an insurance company and wrapped a private equity structure into an insurance company with a theme. And the whole thesis behind what Mark was trying to do was, hey, the banking environment is fundamentally flawed because there's this mismatch of assets and liabilities, and banks, because deposits are daily liquid and they're always lending long, there's this, the banking sector is broken, and the banking sector isn't the future, and there are these secular trends that are going to take credit private. And he was right. He was absolutely right. And you saw it with SVB, you saw it with all of the banking crises that have happened. But I think when something that Mark's also said, and what it made me it reminded me of it when during Ian's presentation. How relevant are the last 10 years of track record, right? I think how relevant are the last 10 years of track record, because are the tailwinds that have been around the past 10 years, are those going to be existent in the next 10 years? And I don't think so, right? I think the tailwinds that have been around with us with the monetary stimulus, the cheap debt, the lack of geopolitical crisis and banks that are really just giving away free money and extreme government spending, I'm not sure those tailwinds are going to be here for the next 10 years. So why should we always be thinking about history? We should obviously be looking at history for lessons, but I think what Ian's presentation told us this morning was that we were all expecting a recession, and by the way, all of the data would have proven that we should be in a recession right now, but we're not. So we need to start rethinking the way that we fundamentally think about the world of investing. And I think what Mark did with institutions and rethinking about investments for institutions, I think the same goes true for individuals. And how do we start figuring out ways that individual investors can access private markets? You can see on this slide that over the past 2 decades, we've seen almost a 500% increase in the number of private firms. and a 42% decrease in the number of public companies, right? People are not incentivized to operate under the public company structure, given the regulations, the volatility, having to deal with quarterly Wall Street analysts and always managing to that quarterly analyst call. I think people have said, if I can stay private, I'm going to stay as private as long as I can. And I think the private markets have started to form and gain scale in a way that's really allowed companies to stay private, right? So we have 5 times as many private equity-backed firms in the US as there are publicly held companies. If you're just an individual investor, how do you maintain a diverse portfolio when 80% of your portfolio isn't in the market? You're only in public markets, right? How do you maintain real portfolio construction in that traditional 60-40, equity fixed income allocation that your traditional portfolio has been in? I think that there's always been this perception that private funds are always more risky, and that's one of the things that we need to educate people on more, is that I think historically, right, private funds have always been venture capital, or they've been traditional private equity, right? Private equity as in the product type, not just equity in a public company. And I think that has changed, right? So if you just look at public REITs versus their private counterparts, public REITs have had 3 times the volatility. From 2007 to 2010, public REITs fell 50% versus private REITs at 25%. And private real estate has generated 5% higher returns than public equities over the past 10 to 25 years. So I think the question that we're asking ourselves, and we're asking many of when we're thinking about how do we build products for the future to scale and really provide investors opportunities to take advantage of what PEG has to offer, one of the questions that we're going to be asking people is, how valuable is liquidity, right? I think there's always been this perception that liquidity is so valuable, and because when in times of distress and when you need your capital, you can always sell your assets, right, and just get that liquidity. I don't know when the last time that any of you went to your advisor in a downturn and they said, yeah, just sell your assets in a downturn and generate liquidity. Just sell your stocks. This is a good time, right? That's never happened. So, but just look at this, right? So there is $38.4 trillion in retirement assets. There is $7.4 trillion in 401k plans, right? These people have 40, 60-year time horizons in some instances. Why are they focused on daily liquidity? Why are we focused on public markets liquidity when you have a 40 to 60-year time horizon? So I think as we move forward, and one of the things that I think is going to be incredibly exciting for me, and I want to go back to, again, first and foremost, my focus and our focus as an organization is on the existing book, navigating the risks that exist in the current book, and delivering on the returns that we spoke to you. And we want to be the absolute best partners we can. We look forward to your feedback. Again, both positive, what we're doing well, and what we can improve on. We know we're going through quarterly, in-detailed fund reviews with you that are happening, on a quarterly basis. So we're not doing that here in front of everyone, but everybody can please attend those sessions. We hope you attend those, and we look forward to your feedback. But I think there's a tremendous opportunity as we look forward in 2 particular places where we're going to start. And when Cam and I and the rest of the team sat together and we said, where is PEG really positioned today to execute and take advantage on the market opportunity that exists? And one was residential, and the other was hospitality. You saw the org chart there. 50% of our book is in residential. The other 50% is roughly in hospitality.
And one of the things that we talked about was, why, people ask me a lot, aren't you starting a debt fund, right? Because people know me for doing that. I said, I don't think this is the time. I don't think this is the time. There is so much capital that's come into private credit. I think this is the time to invest. And you're going to see over the next couple strategies that we're going to talk about. Lauren's going to talk about the opportunities that we're seeing in hospitality, and Soren's going to talk about the opportunities that we're going to see in residential. And we're going to be creating a diverse set of different ways to get access to these opportunities. So we'll have direct access. We'll have co-invest alongside funds. We are planning on launching evergreen vehicles in this space, really to target kind of that mass affluent private wealth universe that's become a huge part of the industry. And I think when you look out and you see a lot of the headlines, the big names with their open-end public REIT structures saying, hey, we're having liquidity issues, this is an amazing time to start a new vintage where people don't have to worry about those legacy valuations, have to worry about liquidity issues, and come into one of those funds in a perpetual nature. And again, I would say a lot of those headlines, I would encourage you to read through. If you think that you're going into a liquid vehicle, you're not, right? And so this is this whole thing about understanding liquidity, understanding where you need it in your book, and helping educate people to how they should be appropriately investing. There's a massive universe here, and I think as we look out over the next 10 years, in addition to these two products that we're going to be developing in the near term, we're going to be going across the spectrum. You're going to see us doing more in opportunistic, more in value add, more in core. We're going to see public market. We're going to see private market funds. We're going to focus on infrastructure. We have really big plans and big visions for the future, and we're really excited. I'm really excited to be here and have you guys as partners. So with that, I want to bring up Lauren Berkeley to talk about opportunities in hospitality.
Sir. Okay. Garrett officially used every minute of my time slot. One of my two bosses now that's taking up all of my time. So I'm going to recalibrate my expectations. As I looked through what we're trying to do in hospitality and how to grow in a time when transaction volume is at historic lows, and as several people have now pointed out, there's a lot of liquidity on the sidelines that's not eager to jump in. And I looked at the slides and this abundance of data, and I thought, the best way to really paint this picture is just to talk about the pipeline and the deals we have in the pipeline, and what are the catalysts for those deals being in the pipeline and being in the market, and why do we think they're interesting. Fortunately or unfortunately, painting that picture for me is a little bit easier because I asset manage some assets that are facing some of the very pressures that we're now trying to take advantage of. So as I talk through some of these, let's just pretend for a minute here that we were an investor, or you were an investor in the early 2000s. Diversified commercial real estate, you did some office, you liked your multi, maybe you had some industrial and retail, whatever, right? Main four food groups. Conservatively leveraged, you got through the financial crisis all right, you came out and you saw some opportunities in hospitality, or maybe your advisor said to you, hey, you should really check out this asset class. You studied it through the 2010s and then late 2010s, and for simplicity's sake today, let's just say you decided to jump in 2018-19. Okay, you went out, maybe you got some floating rate debt. At the time that was 2.5 on your base rate and 300 points on your spread, right? So you're 5.5 all in, things are going well, everything's stabilized, the economy's moving, it's growing, it's not going wild, but it's fine. COVID hits, okay? Your office space goes empty, your multi's doing well, your hotels go to zero for a little bit, okay? And then they bounce back, albeit slightly. Your office is still struggling, Maybe you took advantage of some good rates on the multi and refi, who knows, okay? But across your portfolio, you're seeing some stress and some problems. With your hotel specifically, okay, you decide, you know what, I'm not gonna do my renovation right now. I can't put any money into FF&E. I've got to hold it for payroll, I've got to hold it for ops, you name it, right? Maybe you're funding those assets along the way. You continue through COVID, maybe you don't refi when the rates are low, and you say to yourself, I'm going to ride it out, okay? And all of a sudden, as several slides pointed out, those rates popped big time. And perhaps all that money that you set aside for your renovation now went to hedging your debt. Okay, those caps were very expensive in early 2022, late 2021. So now you've kind of drained that bucket you had on the sidelines, and all of a sudden, you're one of these people, okay, so your rates are up, and all of a sudden you're one of these people who is facing a maturity. And you have to make a very difficult decision today, all right? And you go to your banker and you say, hey, look, you know what, I know it's maturing, you've been very patient with us, thank you. The banker says, no, you know, we want out, you gotta pay us. And so you decide, well, let's go figure out what I can do on a refinance, okay? And the new cost of debt, okay, your base rate, if you're just gonna go get a float, or let's say you're gonna go and you're gonna find maybe it's a debt fund, or maybe you've got a good relationship bank, base rate's 5.5, okay, your spread here, maybe it's 400 over, okay, so you've gone from 5.5% in your debt, now you're north of 9, maybe you're double digits, depending on what your asset's doing, all right? And that value impairment, okay, now results in a LTC, a loan to cost, that's way out of whack. Not gonna work, okay? So the lender says, well, your value's down, we're only gonna give you, you know, similar percentage, but that's gonna require a pay down, okay? And then the lender says to you, well, hang on a second, what sort of CapEx do you have to do, okay? And for 4 years, you've been putting off the brand mandated PIP. Now they're knocking on your door and they're saying, look, enough's enough, it's time to pony up, your GSS scores are low, it's time to go fix the asset, okay? That PIP, that was maybe 7 to 10,000 a door. Maybe today it's 12 to 15. Okay, either way, you don't have the money because you spent it on your rate caps or your debt's gone up with the rates, and you're saying, well, not sure. So value comes down even more because the new buyer's got to build that in. Okay, that's an element of hospitality you might not have in other asset classes. So you're saying to yourself, oh, hold on a sec. What am I going to do here? I've got multi that I really like. I've done office well. I want to keep it. Miraculously, maybe it's come back. Okay. I'm just going to sell my hotels. It's got to go. I'm tired of operating them. My manager's not doing well, or what have you. We want out. Okay, so 3 big catalysts there. There's a couple others that we've seen. I call it ages and stages, and I credit that. I don't think he's here today, to one of our partners. We have some folks who candidly just don't want to do it anymore. It is an operationally intense product type that takes a ton of focus and a ton of time, and they've had it. It's not as passive as they think. That's driving some other opportunities in our pipeline, okay? The brands themselves, forget the CapEx, the extension of these franchises is getting shorter. That is a direct hit to value, okay? These brands are very valuable. The second you take term away from the new investor, the quicker they are to impact valuation. That's getting harder. You start to lose that flag, or you get towards the end of the flag and you're uncertain of where that term's going to go on a renovation or executing a PIP. That uncertainty is going to impact your value. Multiple assets in our pipeline are starting to come from that. Finally, people are saying to themselves, enough's enough, right? Let's move it. Let's take our lumps, let's move on, let's protect what we have, that we like, that we know, that we want to keep. Hotels are not our thing. Call me anytime, okay? I'll talk to you. We're going to take advantage of that. That's just acquisitions. We are a development company. That's what we always did, right? They did it well, they did it great, long before I ever got here. We're not going to stop, but we have to be selective. Part of the way you're going to get away with development today, even though the basis is higher, is the imbalance of supply and demand. Go back again to the GFC, right? You came out of that, 2010, 11, 12, 13, 14, 15. It took 7 years to get supply back to above 2%, okay? If you look at supply in 2009, it was like 2.7%. You got an asset done and out of the ground and operational in 2009, A, you were lucky, but B, you were even luckier because there was nothing after that. And the hockey stick in demand far outpaced anything you saw in supply, okay? We have got to get some assets built today. CBRE just released their CAGR through 2027. It's sub 1%. And it isn't much more than that for several years later. Okay, so there's an opportunity here to try and figure out how to get some developments done. Okay, you are still seeing, okay, and our extended stay team is a culprit of that. Assets coming out of the market too. So that's going to continue to benefit that, right? So not only are you not seeing new ones built, you're seeing old ones come out. I'm actually going to roll right through this one because this is a Graydon thing, and he does a much better job talking about it. But how do we grow and where do we focus? We grow with what we know. We've got a portfolio of very good select service assets, a lot of extended stay. Our PEG hospitality management team has done a phenomenal job with this. Okay, you know, you start out with what you know, and then you expand your wings down the road. But right now, we focus on what we've done best. Okay, these are smaller footprints, less capex, less labor. Okay, especially in a time like this when labor costs are escalating, cost pressures everywhere in the P&L. Let's focus on the one thing that drives high margin. That's rooms, and that's what these products do. Our brands, Marriott, Hilton, Hyatt, great partnerships there. Those are the ones that have a great pipe into the system. They feed demand, okay? They feed out of their demand or their sales systems, right? Their revenue management systems are strong. Yield stability, I think a lot of people realized over the past 5 years, especially coming out of COVID, that these products, these select service products, are a much better investment than they ever realized. Okay, you've seen Mission Hill, that's a spinoff of KSL, huge multi-billion-dollar PE fund. I'm blanking on a line, Prospect Ridge, another PE firm with a spinoff directly into select service. The attention on this product type is more than it's ever been. The liquidity is there, okay? Your audience to sell these, either out of development or after a successful acquisition and business plan, is bigger than ever. Hopefully it doesn't get too big. Talked a little bit about the reason for these, but yes, margins are higher, okay? Fewer FTEs, all rooms product, right? You're not relying on ancillary outlets to drive the performance of these properties. Yeah, less levers to pull, but your one base driver of this product is very high margin, okay? Where do you develop? We're going to keep going with, we've got several Residence Inns that we're working on. Hyatt Studios is a mid-scale extended stay. It's meant to fill a void, okay? It's meant to fill a void where there's only one product type in the market that targets that type of consumer, but it's also extremely flexible. You can flex it into more corporate transient and shorter term stay, or you can flex it more into a longer term stay property, okay? Super simple for developers to develop. Hyatt's been a tremendous partner. We've got a great agreement with them that targets 15 to 20 of those over 5 to 7 years. That's a brand that has the real potential to take off. This is just an example of one we actually did this year. Some in this room might recognize this. Core Plus Profile 2, right? Ian suggested you need alpha. This one was chock full of alpha, right? And this is one where you can take advantage of an asset manager that wasn't meant to be asset managing hotels, and a management team that was asleep at the wheel. And I don't mean any disrespect by that, but that was just the nature of the situation, okay? There were pressure points within that portfolio on their loan, and they needed to get it off. They needed to sell. It was a great situation. It just happened to be in our backyard, and it happened to be in a market where we have a very deep bench of people to pull from and expertise to rely on. Maybe a perfect storm. You don't see that one very often. So you have to do it when you get it. I made up some time, so I'm going to give it to you. Talk residential.
Okay, I'm the Soren of the Lorne. People call me Lorne, and that's okay. I'm not a. Do people call you Soren ever? Not, no. I do get Lorne. I get Lorne often, but they don't call you Soren, do they? Yeah, I don't know why. Okay, they're looking. I'm glad. I take it as a compliment. Thank you, Lorne. So, You know, as I've been listening to this conference and listening to some of the comments, I realize that you are most likely going to be asking me or Lauren or any of our PEG people, what do you think about the new CEO, Garrett? I mean, that question has come when they find out that we have a new co-CEO. What do you think about the new, the leadership? And across the board, I just want you all to know across the board, we are super excited for this. The executive team, the managers, we're all on board. We've all met. Garrett stepped in, and Garrett has been just roll up his sleeves, help us out. He's already provided a lot of insight and a lot of instruction for us in our teams, and so we're all excited about Garrett. And so you don't have to ask that question. You don't have to worry about that. But that's an answer across the board. So really excited about the future. I'm sitting up here getting pretty excited about the investment opportunities, and you're going to hear a few things again in this presentation that I'm going to give that you've kind of heard already, but multiple messages obviously drills in the principles, and so I'm excited about the residential opportunity that we have here at PEG. And you look back, the La La Land that Kimberly was talking about, it's so true. And you think about everybody seemed to be doing multifamily during the La La Land period of time. And it was interesting when we were doing all this. We talked to a number of other developers and other investors, and everybody was in the multifamily space, in the residential space. And so you see things coming up all the time, and you're all astute and you're all aware of the supply that's in the marketplace in certain locations, like downtown Salt Lake City. And you're all aware of what's going on in that world, and there's some things that maybe you're not aware of that are happening, but the key is for going forward. It's going to be tough. It was hard before, but a lot of people got into it. But going forward, we saw some of those slides that were put up that we're kind of in this pace that we're going to see for the next few years. It's hard. It's going to be harder to do residential development acquisition unless you have an edge. And what we've developed at PEG is that edge. And I'm really excited about that. As I sit thinking about everything, what is that edge? So I'm going to talk a little bit about that and how we're sliding into that edge. A lot of it has to do with the vertical integration, where we have our property management, our construction team, our investment team, asset management team, development team. We're all there together, and I can walk right down the hall. Deborah, how do we do this? Tell me information about this. Matt Hansen, development, entitlement, construction. Nate Buckner. Nate, we need pricing right now. How do we get this? Nate, and we work together as a team. Property management sits down with investment management and with construction, and we can hammer out how to not the word value engineer, but you're familiar with that, but how to get the numbers in line, and then we can go forward. We just witnessed that this last week with this Santa Fe Residence Inn with the hospitality team. Construction got in, figured it out, now we're going to go forward, so it's great. Wall of maturities, we talked about this. Lauren showed his slide. You've got about a ton of multifamily loans coming and maturing soon. We actually think that some of that's going to get pushed out. But more importantly, if you look at the slide on your right, handful of that is problematic. And Garrett talked a little bit about the acquisition opportunity that we're going to see. And so we're excited for that, especially with Garrett's background on the debt. We see that there could be some debt, some opportunities for us to pick up assets where ownership groups just don't have the liquidity ability. And this next slide, I tend to use arrows. You obviously are looking at that big green arrow, and Garrett mentioned this, that a handful of years ago, debt was super cheap, and now a lot of that's coming due. What's happening? So a lot of these assets that we saw in the previous slide that are challenged, those assets are not able to meet the performance requirements to get extensions or to get cash out refinances. And so we're even seeing that a little bit in our portfolio, but we're able to make adjustments and make changes quickly with our property management team. We're seeing these things happen coming up. So working with that. So arrow going down, this line. So if you follow this line, the multifamily construction starts. You see, we all saw this. If you're driving down the I-15, construction just went crazy, right? And so you're seeing what's happening now with construction starts. It's way harder to develop multifamily product, and you're seeing it with this line. And then the deliveries follow. So you're seeing, just like Kimberly mentioned, the delivery aspect is going to be huge for us. So we see this big gap, and those who do really well on the development side and have those edges are going to be the ones who are going to be able to take advantage of that gap. Multifamily supply and demand. There's a big bar on the right that I circled or put a square around. So a lot the shortage exists, and you're hearing this in the news. We're seeing it. There's still a significant demand for multifamily and residential housing. Another big gap, the affordability factor. So it's cheaper to rent than to buy. Not surprising. Everybody sees mortgage rates. So what's interesting still is we're seeing that gap was huge, right, in 2002 or 2023. It's still going to be there. So we're forecasting to have this gap for quite a bit of time. So the rental product, if you just think through and absorb what Kimberly mentioned, the rental product is going to be a product of demand for quite a bit of time going forward. Okay, so this is going to be like the fourth time I think you've heard this concept, but coming out of times of market dislocation. You can see these gray bars, right? Those are always indicate these times of market dislocations, these recessions. You can see coming out of the early 2000s, what happened to core private real estate and valuations and returns. So you can see the first arrow on the left demonstrates what came out of the early 2000s. Increases happening. Coming out of the great financial crisis, a big pop. To Kimberly's point, the individuals taking advantage of the dislocation at that time and investing at the right time benefited from those returns. And I have this, I couldn't find, you know, on your iPhone, the double exclamation mark that you hit and you're like, yeah, that's what you want to emphasize. I couldn't find that in the shapes in PowerPoint, so I just have a lightning bolt, right? Boom. Time to invest, take advantage of this time. And so, you know, in my slide, and we really didn't coordinate these slides as we mentioned before, but just one more time, we really see that this is the opportunity to invest in multifamily. But again, you know, you can say in residential, invest in residential, but with who? And what we hopefully can give you, and what we've done hopefully as a company, is demonstrated the fact that we have this specific edge. So going forward, so what does this mean? What are our actions? Challenges, right? Lending, obviously refinancing. Anybody trying to get into refinancing to a perm loan going to have challenges. There's liquidity issues. Construction loans, rates are high. It's very challenging. Still, construction costs are high. We don't think that that's really going to go away. It's not going to go up like they used to, but we think that hurdle exists. So how great is it to have a construction company in the office right next door to our teams that we can go to and constantly say, how do we do this? How do we do that in order to bring our construction costs down and get them in line? Rent and expenses. Rent's going to be relatively flat. You saw from Kimberly, in some locations, in some areas, you can see rent declines. So you have to be careful in the locations that you're at. And expenses are going up. Labor costs continue to go up. We're not getting away from that. So it's tough right now to manage, to develop, to finance, and you need to have that edge. Opportunities. You see my bottom bullet point that kind of gave it away, but we'll get to that. Still a massive need for multifamily and all things residential. Acquisitions, debt, refinance, development. So we are looking at the acquisition side, as Garrett mentioned, and to Garrett's background with the debt, having that knowledge and understanding, that's going to be great for us. Development, who will succeed? The vertical, those companies that have the edge, and we look at our vertical integration and our experience that Cameron mentioned, which I'm going to talk about here in a minute. Affordability continues to get worse. It's very challenged. We have a product we're going to talk about in a minute. And demographics of renters. So you remember that chart that Kimberly showed with all of the different renters. We see that there's a lot of renters coming in, but we're also seeing and catering to the number of renters on the end of that age spectrum with what we have. So management and experiences. So and I've been asset managed, just like Lauren has, I've been asset managing a number of assets with our teams. And we are seeing that management and being able to work with management and having the systems that we need is so critical to be able to make decisions quickly and continue to drive and watch what's happening in the markets and make changes immediately. And then we're focusing on the experiences. So to talk a little bit about the residential curated experiences. So I was not an English major, but I did okay in regular English, just like maybe there are many English majors here. So I had to look up what that word curated means, and I have my note right here, because I got to read this, okay? Because we keep using that. Cameron was using that, and he was very astute. And I'm like, I don't even know what that word means. This farmer knows what that word curated means. I don't know what that means. To curate something is to carefully choose, arrange, and present different items in order to get a particular effect. It's like, I like that, right? So being intentional on the experience that we have. So a major focus of what we're doing right now. We get a lot of data from all these markets that we're in, and we're looking at how do we even have an experience meeting when we meet with our property management team, our investment team, development team. We talk about what's the renter experience, and we go through the whole process trying to figure things out. So the product and classes that we're in, Class A core, we announced that we're going to have a name for it. It's going to be GB Living. I don't know, I'm just kidding. But Gunter Bjorkman Living, maybe that's, if we use that, maybe I'd take credit. But Class A core, so this is our bread and butter, this is what we've done. And we continue to look on the development side and acquisition side for Class A core, multifamily in great locations. Our value add product, this is the Avia brand. We call this our affordable luxury. We have gone in and we've re-entitled a number of older extended stay hotels and converted those to workforce housing, so attainable housing. Not essentially affordable, quote unquote, but attainable. But even with the attainable housing in these areas, in these markets, we're seeing that our rents are still probably like 63% AMI on average. So we're below even that workforce housing range of 80% to 120% of AMI. So we're hitting not only the workforce housing, but we're also kind of sliding into some of the affordable housing incomes. And so that product is leasing up really, really well. Build for rent, we've talked about build for rent and these discernible tastes that these renters have. And that's why it's taking a little bit longer to absorb, because these individuals come in, they don't necessarily want they can't really afford to buy a home, or sometimes they can, but they're looking for the flexibility, but they're looking for a little bit higher level of living, nobody above them or below them, but a number of, or quite a bit of flexibility, excuse me. And then our student housing product. We've had great success with our student housing properties. In fact, the green is we've increased rents almost 5% from this year to this next year in August when those leases start. So 5% increase in that student housing product, and we are 67% pre-leased, where the market is about 62%. So we're having great success, and we see this opportunity. Again, I go back to taking it all in. Vertical integration has significantly helped us have the edge in residential development and investments. And so I'm really excited for that in the future, and hope that you can all be a part of that. Thank you.
Okay, sorry, remind me, what were you at BYU again? What was it? There we go, offensive lineman. Okay. Okay, so we're going to take a break. We're a little bit behind schedule, but I'm going to give you guys your 10 minutes. So 11:35, be back here. There's some, I think, veggies out there. We are going to have lunch at 12:30. And then I'm supposed to do some sort of shameless plug on my podcast, but maybe not. But anyway, if you haven't listened to the podcast, please download. We had Richard Barkman, who is the chief global economist on CBRE a few weeks ago. Garrett will be doing a session as well. We've got some other folks too. So anyway, let's break, everyone. Thanks. Cue the music. No music? Okay, everyone, I'm between you and lunch, so let's take seats. We're gonna start in 30 seconds. Everybody, it's a good lunch. Hearty food. Okay. You're gonna roll the video?
PEG construction started because of our strategy behind the residence inn conversions.
Some of the bigger challenges we had were cost controls, quality inspections.
Converting residence inn properties to Class B apartments, we felt like we needed to have our own construction company to control the outcome of those conversions.
So when it was time to start our own general contractor, we said we know just the person who would come in, work within the PEG family, and grow this and own it. And that was Nate Buckner.
Building the team was absolutely critical. Finding the right guys, superintendents, project managers, accounting team, project engineers.
We saw real value in trying to keep stuff in-house where we could control more of the outcome as far as working closer with the development teams and with our property management teams.
We're trying to create a group of people that can consistently deliver the same positive results.
I often use the words extreme collaboration, where if there's any kind of issues that come up, if there's any questions or anything that arises, the ownership team is literally sitting right behind us. I can literally walk out of the office, walk down the hall, go over and talk to them, and resolve issues immediately.
PEG Construction's geographical footprint is actually fairly large. We have everything from Kansas, Indianapolis, down in Texas, Kentucky, with more projects coming. So yeah, we're definitely a national reaching company.
Got larger projects here locally right now. Brick Creek Phase 2, a brand new multifamily, 5 stories of a stick frame build, over 3 stories of a concrete podium parking structure. Brand new construction. We've also got brand new office TIs.
PEG Construction finished our corporate offices here in the Freedom Commons buildings. And if you really want to see a showcase of PEG Construction's abilities, come take a tour of our office.
Our strengths include owner procurement, value engineering,
Bringing over critical path method scheduling techniques so that you can shrink the durations of the jobs and predict where you're going to be on what day in the future.
Pre-construction services is a huge part. The opportunity to have a general contractor sit down with the owner during the actual design process and to offer different suggestions. I can save you some money by doing a brand B as opposed to a brand A and give you the same look.
With inflation, construction costs, shortage of labor, it's really important that we've got to find ways to reduce our costs, and this is the way we do it.
We get full transparency into the bid process, to the subcontractor selection, the pricing, the markups, every aspect of construction.
Being backed by PEG companies and seeing just how big they are and how much of an influence they have just in the real estate market I've seen here in Utah is, I don't know, it gives me a lot of confidence that PEG Construction's here to stay. I wake up grateful every day to be able to come to work. I think PEG Construction is going places, and it's great to be a part of it.
Okay, thank you. So we're going to head into what has become a tradition here at PEG is the CEO fireside chat. We've had a few CEOs grace our stage over the years, and when we decided this year on our PEG360 theme, we're thinking about how operations is so crucial to delivering the distributions that all of you folks expect and in need, of course. So what better group than SkyWest Airlines, who has such an emphasis on operations and has excelled in that and Cameron will discuss a little bit more on that background. But I thought it'd be helpful for you to meet this Chip Childs, who is the president and CEO of SkyWest. He was named CEO and nominated to the board of directors in January of 2016, and he has served as president since 2014. Chip also serves as deputy chair of the Federal Reserve Bank of San Francisco and as the Intermountain Health Desert Region Board Vice Chair, chair of the Regional Airline Association, and is the chair of the Next Gen Advisory Committee of the Federal Aviation Advisory Council. Lots of chair. Woo, okay. He earned his bachelor's degree in economics and his master's degree in accounting from BYU, Brigham Young University, which is my alma mater. And he and his wife live in St. George, so we appreciate you coming all this way to grace our stage. So welcome, Chip, and of course, the illustrious Cameron Gunter.
Thank you, Rachel. Well, Chip, first of all, I'm thinking here we got several things in common. One, both CEOs. Two, we both have our last graduating from high school in a couple of, well, mine's tomorrow, yours is in a couple of days. We both lived in Cedar City. Now, at different times in our life, we lived in Cedar City. I didn't grow up in Cedar City. I just lived there in a crazy house, probably not doing the things I should have been doing. And then we're both accountants.
Yep.
So amazing. Let's hear a little bit about you and SkyWest and your journey in SkyWest and explain. SkyWest is a little bit different than probably other airlines.
Yep.
I'd love to hear a little bit about that.
You bet. Well, I graduated from BYU, worked at a big firm called Arthur Anderson that doesn't exist anymore, and I moved my family down to St. George to get in the airline industry the weekend before 9/11. So it was a great journey, and we kind of learned quickly that life is a little bit chaotic, and sometimes that's a good thing. Let me tell you about SkyWest. SkyWest is 52 years old next month, and it started out as a very small regional airline, and we have grown to a fleet of 600 aircraft. We're the largest regional carrier in the world, and we're one of the largest airlines in the United States. We have a unique model where we fly specifically for 4 partners: Delta, United, Alaska, and American. And those 4 partnerships are critical to what we do as a business. And we've often sometimes debated, who's our customer? Is it the 40 million passengers that we carry every year? Or is it going to be the 4 partners that we actually have to work with? Because if you look at, even in the video, all of our aircraft are painted in their livery. Our flight attendants wear their uniforms, and we're in charge mostly of just making sure that the operation is on time and does exactly what our partners want us to do. We operate under contracts, so when you go and you buy a fare on Delta and United and it's our airplane, the money is not, we don't control what that price is. That's Delta, United, American, Alaska that does that. We enter into a contract with them to fly from point A to point B over a certain schedule of the month, and we get paid to do it as long as we do it really, really well. So we've determined that our customer really is the 4 parties that give us those great big wire transfers every Friday afternoon. Kind of makes sense to me. Now, we have metrics that make sure that we take very good care of the customer, and we have an employee base of about 15,000 employees, and we're spread throughout all the United States. For those of you who fly in and out of Salt Lake a lot on our airline, Salt Lake is not our biggest base. We have a couple of other bases in Chicago and Denver that's even a bit larger than Salt Lake, and we're all over. LA, San Francisco, Seattle, Portland, Phoenix, Houston, Detroit, Chicago, Minneapolis. I mean, our route map is just absolutely enormous, and I think a slide may come up on that. So it's a great business. It's fun. I love the airline industry. We focus primarily on our people. We don't make a strategic decision at the airline that we don't consider the impact of our employees first, and our partners and our shareholders of our employees are first, and I think that's a key part of having that culture that's going to create the sustainability over 52 years that we've had. And going in the future, we're the only airline that's not furloughed a pilot, a flight attendant, and a mechanic in our history. And we're also one of the few that have never filed for bankruptcy. So I think I'm done bragging.
Pretty impressive. Very impressive. So, look, last year we had, I had the opportunity to have Mark Hoplamazian on our panel, who's in the hotel industry, who's really, I think, very similar to like a Delta Airlines or one of those airlines to us in the hospitality space, where it's their brand, and they say, look, it's their customer, they're acquiring the customer, similar to what you are there, where your brand is, I mean, SkyWest's the operator, but the brand is really the Delta or some of those, and we have very similar to that with Hyatt, Marriott, Hilton. And so we have some very similar, I think, industries.
Yeah.
And we also had some similar industries as COVID hit.
Yeah.
So let's talk a little bit about, you know, how you transitioned in COVID and how you're able to survive through that. For us, it was challenging, but because we operated and we managed our properties versus having somebody else do it from an investment firm, we were able to shift fast and be able to do the things that we needed to do to really keep those properties open and keep it from losing it, similar to you guys not having to go bankruptcy. So talk to me a little bit about how you managed through COVID.
Yeah, so I think, particularly in my career, I went to SkyWest right after 9/11, and we watched the towers and the Pentagon and all that, and it was a huge shakeup for us. But we learned some lessons from that, and we learned some lessons from the crisis in '08 and those types of things about agility and making the right decisions with our people. But among all those challenges I just talked about, COVID was by far the scariest. You know, I mean, when we saw those bookings as an airline, just every single day we're like, okay, this has got to be the bottom. No, every day for about 14 to 24 days, we saw those bookings at our major partners go down and down and down and down. And it got to a point at the heart of COVID where we were actually flying about 30% of our normal schedule. And it is really hard to fly 30% of a normal schedule, and there's nobody on the airplanes. There was a point where we thought, let's just shut the whole thing down for a while. So navigating all of that, then the nucleus of what we decided was, what do we do that's best for our people? You go through the math. We decided not to furlough anybody. We decided to continue to make sure we were renegotiating some contracts with our partners to help them because they were hurting worse than we were. We went back to our aircraft suppliers. You know, we were basically renegotiating all of our contracts to get through on the other side from a cash flow basis. But most importantly, making sure that we weren't putting undue burden on our employees, making sure they knew that we were going to take good care of them, and then make some of the right decisions. And in all honesty, you can see from this picture, we're lucky because our aircraft are big, but they're smaller. And when things get bad, you kind of go to the lowest common denominator. And so we were actually the first airline to come back as we started to get back more comfortable with what was going on with the virus. So that was very helpful to us, but I continue to this day say the way we treated our people, our partners, our investors, you know, they took a shot, but every investor, you know, took a shot, and we kind of fixed that in the last couple of years. But I think we put the priorities in the right place, and as we did that, as technical as the airline industry is, these relationships are still with our shareholders, our partners, and our people are by far the nucleus of everything else we do. Everything else is very tactical, but it's got to be centered in those relationships.
Yeah, it sounds a little bit familiar. Now, you saw Dr. Wright show the slide about travel.
Yep.
Where I don't know if you had a chance, and then we've talked about the travel industry up. Lauren showed some of the demand up in the travel industry, and so now we come out of COVID, and what do we see? We see now we got people. We gotta take care of people. We're in the hospitality business. How do we do that? But we don't have the people to come, and so how were you able to? And talk to me about some of the challenges of coming out of COVID as demand picked up. Some of the challenges from staffing, fuel prices, maybe inventories of jets. Yeah.
So, as you remember, the government gave out a little bit of money, an enormous amount of money. And what the major carriers did is they immediately saw how expensive the top level of their pilots were and thought, well, what we need to do is early retire all these, you know, baby boomer pilots that are perfectly capable of flying. And so they gave them these packages, and they came off what's called the seniority list. The most expensive pilot is your oldest one. So part of their restructuring, they took probably about 8,000 pilots out of the industry during COVID, nobody having a clue how fast and hard travel would come back after being cooped up watching Netflix for a couple of months. And all of us were,
I thought they watched Netflix while they're flying.
yeah, we were absolutely astonished, the entire industry, about how fast the travel came back. And to this day, we're still pretty astonished that it's still here. So when you lose that much supply of pilots and we can't adequately get to the demand, we came back okay at the end of 20 and in 2021. But all of a sudden in late 2021 and 2022, I'll give you some statistics. In pre-COVID, we had about 5,300 pilots. By the time COVID, by the time we got out of COVID, we were flying probably about 90%, 80 to 90% of our schedule. Then all of a sudden our pilots started going to the major carriers because they can make so much more money flying a bigger airplane. So the attrition of our pilots was just staggering. So today we're down to about 4,300. We lost almost probably 3,000 pilots in about 18 months. But our pipeline was very, very strong, so we're able to recover. But in light of those numbers, again, 2019 was about 5,300 pilots. We're at about 4,300 now. So I need another 1,000 pilots to get back to where we were. And demand for travel is so strong, I probably need another 1,000 pilots on top of that. So from our perspective, we're now making tremendous progress. Building captains, it's hard to, when you have the pilots up in the flight deck, you see the one on the right side, that's the first officer, the one on the left side is the captain. He needs an extensive amount of time and training before we can have him come from the right seat to the left seat. That's our challenge today. It's just that all of our pay for all of our employees has increased significantly, but we're still so comfortable with the demand that we're still on a slow growth, back to normal and even beyond it. So despite, what we talked about relative to just our normal commercial operations, we've also started a charter operation just because of the demand for that level of flying since COVID has just absolutely exploded. So it's interesting the dynamics that we need to be agility, make sure that we're agile coming out of COVID for all these different opportunities and restrictions. It bodes well for us long term though, all things lined up.
Yeah, so does that make us smarter?
By accident?
Yeah.
A bit.
Okay.
I mean, we did stumble into a charter operation because we had so many airplanes sitting around with nothing to do, and we started something else up. So I want to say that it makes us smarter, but there's a lot of things out of necessity. It's a lot more important to be agile than smart, I think.
And I think that's important, is the agility that we can, and we have the people, we have the right resources to do that. So with the shortage of pilots, we always talk about technology in our company, data, and what makes us better and helps us make decisions better. So AI is now out there, which in my opinion is technology and data, trying to ways to gather that together. So with shortage of pilots, let's just have the airplanes fly themselves, right?
Yeah, sure.
Is that what you're doing to fix that problem?
That's not my decision. It's the customer's decision. But I think the airline industry, as you point out, will be an industry where AI will be tested socially. I mean, I think in the next 5 years, as AI continues to develop and do things for our society, we're going to have to decide what we want it to do and what we may not want it to do. And I don't think in our lifetime any of us are not going to want to likely get on an airplane without two human beings up there. But let's be clear, these airplanes that we're taking today, and we continue to take new aircraft, they're fantastic because they use the same engines, but they're greener because of the technology, having the airplane go in a straight line as much as possible, instead of being, when you come on approach to Salt Lake and you're landing north, and they send you clear up to Bingham before they bring you back to the airport. We're trying to cut that down to where it's a very, very short swing into the airport. The technology does a tremendous amount of that, but it also tells us we know when the airplanes are going to break long before they're going to break. That level of data and technology and AI is fantastic for the customer, because instead of saying, okay, something just happened, it'll give you indicators of things that are fine, but things that need to be addressed sooner so that you don't have the mechanical cancel or delay. So, and then, air traffic control, all the other things, AI makes us tremendously more safe. I have more confidence in our system today than I ever have, mostly because of what technology is telling us about other aircraft, weather patterns, turbulence, all that kind of stuff. It's fantastic and getting better by the day.
Well, that's great. That makes me feel more comfortable flying too, knowing AI is making me safer. And I didn't realize that, and hopefully everybody here gets on a SkyWest jet after they leave here. So
good.
So let's talk a little bit about our customers. Let's talk about customers, let's talk about people. As we look at trying to, you've heard us talk about curated experiences today, you've heard us talk about what that customer journey is. What does SkyWest do on, I mean, they're obviously customers that come through a channel,
Yep.
but ultimately they're your customers to get to this, to where they need to be. There's a customer journey to get into your airplane and get to their destination. How do you guys, what do you feel and how do you think about that customer journey and that experience?
So I would say this, because I'm going to revert back a little bit and talk about both of our types of customers, both Delta, United, American, Alaska, and the passengers. The consistency, when you look at our business model, when you see that here we're flying for 4 viciously competitive airlines, and why do they enable us to fly in that manner to where you'd think that we would be playing favorites, which we don't. It means that all 4 of them are amazingly confident about our ability to perform. And so our number one passion is to make sure that we outperform everybody else in our space, but also try to outperform our customer, because they're doing the exact same business that we are. So to the extent that we can outperform and be the top performer, then they're okay with it. And I think society today, we're seeing everywhere in our charter operations and in first class sales and everything, that the premium on predictability and quality has never been more amplified. And you know, for people who, we live crazy lives, we got a lot that we have to do, knowing that the airplane is gonna, you know, depart on time, get you into the destination on time, or if not, let you know soon enough so that you can accommodate that plan. We've never seen anything like it as I've been at SkyWest, where people are willing to pay so much more for that level of premium that it's incredible, which is kind of the nucleus of why these charter operations that we've started has grown in the last 2 years. It's crazy what people want to do. This is a space where the quality hasn't been terrific in charters. We do it commercially. We bring that knowledge base to that type of level of clientele, and we have a lot of people very, very interested in just ordering planes, and that space is absolutely blown up. And so you take a look at all these kind of product lines and all of our customers. We have to be the very best from an execution perspective, and we're seeing that there's an interesting level of what people are willing to pay for that.
Yeah, so when a customer gets on an airplane,
yeah,
who's in charge? Who's in charge of that airplane to make sure that customer, that guest has their best experience? Who becomes the one?
First and foremost, the captain, because despite the fact that if the coffee's hot or you've got the Diet Coke, it's got to be safe. More than anything, it's got to be safe, and it's got to be on time. Outside of that, you go to the flight attendant, and our flight attendants, I think, are the very best in the industry. They probably do more than what we ask them to do from a training perspective, because we find, as we hire flight attendants, we want to find a passion that they are not just accommodating, but they care not just about the safety of the passenger, but make sure that they are having a great experience on the flight. So that's the flight attendant. And then the mechanics, even though they don't interface a ton, they know that it all comes down to the mechanic. I mean, if that flight's not in the absolute peak health, nothing else works on the road. So what we love about making sure that we take care of our people first is if they know that, and we find the right people through the paths that we do that are passionate about aviation and passionate about taking care of customers, all the other stuff takes care of itself. Pretty simply, all the other stuff takes care of itself.
Yeah. I love that. So interesting to see what's happening in the world today. We heard, you know, what's happened with inflation. We heard, you know, unemployment. You know, you get the opportunity to be on a Fed board. One of the things that I meant to ask Ian, and I'm going to have you, I know this is not in the skyline, the airline industry, but you know, as I see, we're a global economy, and you fly globally, or you have some global business, and we see inflation outside of the U.S. a lot higher than what is in the U.S. And when we're buying our products, when you're buying supplies for the or things for the airplanes, you know, inflation's high.
Yeah.
Are we trying to target the wrong inflation number of what the Fed's target is, or should we increase that target And to try to get back to where their target is just not going to happen because of this global economy.
That's an outstanding question. And by the way, we spend a lot of money.
I want an outstanding answer.
Okay, yeah. I don't know if the Fed's going to let me do that, but I'm gonna give you what my thought about. I think the number, by the way, me personally, I think the number is right. I think it's harder to get there. I still think they have the tools. I mean, I think a lot of issues were brought up today that were fantastically cognizant about the issues that we have relative to what's going on internationally. You got international conflict. You have an election year this year. By the way, we buy all of our airplanes from Brazil and Canada. We don't buy any airplanes in the United States, so we have a lot of that risk. We're making decisions about aircraft that we're buying today relative to what we think the interest rate's going to be. I mean, we were very addicted to buying aircraft at 2.7% interest and that type of stuff, but because they're expensive. These airplanes are $25 million a piece, and we need a lot of them. So all of those factors are coming into play. But to talk about is it the right number, I think it is the right number. I think that it's going to get harder to get to that number depending upon a couple of things that may take place at the end of 24 and into 25. But I do have confidence, honestly, that the economists that are there at the Fed are incredibly bright and unbiased, and they're point on their mission. But I think that everybody today sees that these are, the algorithm and the variables continue to get bigger and bigger and bigger around monetary policy. And so I don't have the right answer for you, but I do have confidence that they have the tools in place, but it is a little bit harder than what it used to be, given all the other issues that we have, primarily labor. In my view, for me, the reason why ticket prices are going up in the transportation industry is because of labor. Supply chain hasn't quite hit us terribly, but it is a lot of labor.
Yeah, and I think the same is true for us as we start construction projects and even in our operations, it's labor. Labor is our biggest challenge. So it's really trying to figure out how we can be more efficient with that labor cost and with our people and making the right decisions quicker. So you heard me talk about. So last question, what's next at SkyWest? What's next for you?
Like I mentioned earlier, we're just, a lot of people want us to do some, really sexy, outrageous things as an airline, and we're very, very focused on the base model that is delivering a fantastic return today. We have a lot of hiring to do. We have a lot of training to do. We have a lot of upside relative to pilots and flight attendants and that type of stuff. Again, we're going to continue to expand our charter operation. There's some interesting dynamics with corporations and that we never even thought were even there, and I don't think anybody did, so we're going to continue to explore that. I continue to say I got the best job, in the world, at least for me. I'm not getting any younger, but I'm not, I don't feel like I'm getting any older either. So my objective
You're not looking like you're getting much
well,
older.
I don't know. I think that my two teenagers that are graduating would probably have a different opinion about that, from high school. But
they'll be gone. Now you're okay.
It doesn't matter. It doesn't matter, right? But I think for us, I love what we're doing here. I mean, it is fun. We love, I think, for me as a CEO, love taking a very chaotic world and finding opportunity for our people. In a world that's deeply politicized, our job, I think, as CEOs is to make sure that our people know that we care about them. SkyWest should not be their top priority. It should be probably, I don't know what the number is, shouldn't be in the top 5. But if we can provide them a good career, then they're going to be happy, our partners are going to be happy, and our investors are going to be happy. And it's a fun model to continue to manage. So,
well, thank you, Chip, and thank you for being a friend
thank you
as
for having
well.
me. Yeah.
We appreciate you coming and taking time. I know
Thanks for the returns that you're giving in a couple of my funds too, by the way.
Yeah, make sure we've got that plug. Yeah.
Yeah.
Tell them how great your returns
No,
are.
St. George is good market. It is a good market.
So
it's good. Thanks
yes,
again.
Thank you.
Yep.
Thank you, Chip. Thank you, Chip. We super appreciate you coming all this way and speaking with us and with Cameron. Okay, so it's the perfect segue into our final little segment, and that will be with our operations group. You may or may not be aware, but Rob Fetzer is our Chief Operating Officer, and he oversees several of the companies at PEG, including PEG Hospitality Group and PEG Property Group. So you've got Rob Fetzer, who has been with Cameron since day 1 or 2 or something. So he and Cameron have really built this to where it was attractive enough for someone like a Garrett to come over. So super grateful to Rob and all that. I mean, his passion is deals and development and people, and it shows every day when I see him in the office. Graydon Pearson came to us from In-Group Hospitality Group. PEG acquired them, and so now it's PEG Hospitality Group. Hospitality runs in his family. He's been at this now for 20 years and has worked for all the big brands. So we're super, I mean, if you ever need anything, I'll give you his cell phone. He's amazing. And then last but not least is Deborah Spahn. She's also a veteran in the multifamily property management side of things. And her group manages everything non-hospitality at PEG. So the distributions that you're getting are very important. What they do is what helps yield the distributions that you're receiving. So these 3 are quite pivotal in that respect. So what we're going to do is we're going to have a short little intro to the 2 property groups, and then we're going to have a little bit of a panel discussion to really dig deeper into things.
From the very beginning, as carefree kids who craved the adventure of traveling somewhere new, cousins Graydon Pearson and Carter Frank were born to be in the hospitality business. It all started with their grandfather at the Utah Travel Lodge back in 1959. In the 70s and 80s during their youth, the young men worked hard with their family business in just about every operational role you could imagine, from scrubbing out trash cans to running reservation services. Today, after 6 decades of managing thousands of keys, PEG Hospitality Group operates more than 30 thriving properties for top-tier brands in strong markets across the United States, including a highly successful portfolio of hotels in Salt Lake City.
It was managed by another group, and we weren't quite happy with the way that they were running it.
You know, the returns weren't hitting where they needed to be, and we were struggling with some of the things in operations.
So we pulled it over. They had turned around the portfolios, and they were pushing hard on NOI, managing expenses, and driving up revenues.
Despite the company's rapid expansion and widespread prestige, claiming major awards like CCIM Property Manager of the Year and several Brand Hotels of the Year, there's one thing that continues to set us apart as property managers.
I love the fact that I can call Graydon anytime, anywhere, somehow, some way, he's responding back to me.
Always staying true to our promise, we believe true hospitality starts within our own company. That's why we treat every property like it's our only property.
Graydon and his team manage a hotel like an investment, and they also provide fantastic service.
From revenue management to sales and marketing, our numbers speak for themselves, but it's also those intangible nuances that these days you just can't find anywhere else.
At PEG, we wouldn't go with any other team to manage a property.
Alongside PEG Hospitality Group stands equally important counterpart, PEG Property Group, which manages commercial and multifamily operations at PEG.
How'd you hear about us?
With a bold emphasis on customer service and cultivating genuine connections with residents, PEG Property Group produces above-market results as the operator of choice in nearly every market they enter.
The people here, upon talking to them as I was looking at the property and considering it, were the #1 reason of bringing me here. Everyone here is super friendly.
Led by Division President Deborah Spahn, who grew up working hard with her father at their family-owned business, she operates with the same entrepreneurial spirit and outside-the-box thinking that shaped her upbringing.
PEG Property Group's focus is to be better than market, better in occupancy, rent growth, and the resident experience. Again, it's about results. We always have a growth mindset. We never settle for status quo.
The team has consistently delivered year-over-year rent growth of over 20% at several properties across the United States. PEG Property Group has also earned spots among the top highest-ranking online reputations, which these days is vital.
They want the investment to do well. They don't want to just meet the needs of the residents. right? They want to be a part of that team. They feel a part of winning for the investor.
Best of all, being vertically integrated with the PEG Companies organization means early collaboration with PEG's development and construction teams, providing invaluable insight into the expectations and desires of today's renters. From what amenities they want to what they're willing to pay, providing that crucial data through the lens of a resident gives PEG that unique strategic edge.
It's a huge advantage to be able to sit down with them and think about what's best for the property. An example of that, is Deborah really wanted a pool at 702 Main, the apartments there. We didn't have a pool designed originally, but we did have some savings in the budget that allowed us to add that pool. And at first, I have to admit, I was kind of frustrated. I didn't want to have to make that change mid-project, but it ended up being better for the project.
It's our property management teams that truly bring PEG's vertical integration full circle.
It puts us in a good opportunity even to go out and look at new assets that may be in a lease-up scenario or maybe troubled because the interest rates are high. We have the ability then to bring our operating team to come in and make a difference on the NOI.
Consistently driving Market Plus One performance while also positioning PEG to capitalize on strategic acquisitions in coming months.
The video almost tells it all, right?
Right, we
This is
can
pretty
sit
good.
down and call it good.
Yeah.
I think I said this yesterday. Ally does such a great job now. I'm just going to go up here and look dumb.
Yeah.
Thank you, Ally. It was wonderful.
Well, we're coming to the end of our conference, and one of our wise investor partners who actually is sitting here told me that it's best to go last because that's the thing everyone remembers. So no pressure, but we're coming full circle on this. We're coming 360. We're coming right down to the properties. You guys manage the boots on the ground in both of our property management groups, coast to coast, managing team members remotely and caring for our assets. So let's just jump right into it. And we've heard a lot about the market today from our investment side, but you guys are managing the properties. So maybe, Graydon, let's start with you. What's your take on the market? What's our guest looking for?
Yeah, so my take on the market, we're not quite to the slide yet, but
I'll get there.
just listening to Chip and Cameron go back into COVID time period and talk about COVID, it was really a critical time and a difficult time for us as employers and looking at how we move things forward. When you look at this slide here, this slide comes from Lodging Analytics Research Company, is one of the top groups of gathering data in our industry. And it shows in 2019 where segmentation in our business was really even, where you've got corporate, you've got your corporate group, individual corporate group, and leisure travelers all traveling at about the same amount, staying, occupying your hotels. When COVID hit, that really shifted and went all kinds of sideways. 2020 is what it is, but 2021, when that resurgence happened, all of a sudden our hotels were full with a lot of leisure travelers, and a lot of your corporate and individual travelers were gone. So you're then filling your guest rooms with 5, 6 family members, and your costs go crazy, and labor costs are then going haywire. And so gathering all that up was really a challenge. You see here, wages grew in our industry 29%, while inflation was growing about 9%, 19%. And through that time period and to where we are now, what our customer is looking for has started to really evolve and change. We scale down all of those services and try and really control our costs. And now coming out of that, the demand and the want for more is there. And so what we're seeing is our brands are trying to look to have all or most of their transaction, and the customer wants to have their transaction happen on the app. And the airlines have led really well in this, where you can, you book your room there, you check in on the app, you develop your mobile key on the app, you can arrive at the hotel and not have any interaction with anybody at the front desk if you choose to. And so really what we're seeing in our industry is kind of a shift away from letting the transaction happen as the customer wants to have it happen, and then allowing our staff to really develop and curate the experience for the customer as, on their terms, whether that's in our food and beverage outlets or it's at the amenities around pool, things of that nature, and allows us to really get involved and help develop the experience for that customer at the property and in the destination.
But it's been a really great story because demand has remained strong. So we're still moving on that. But Deborah, we're seeing a shift in demand on multifamily. So what's the renter sentiment today?
Okay. Yeah, the last 10 years, we've had historic year-over-year rent growth. It's been the best multifamily market in my career over the last 10 years, and we are seeing some softening in various markets, particularly the downtown Salt Lake City market, where CBRE reported just under 5,000 units were delivered last year, and another 13,000 units are expected between now and 2026. So with that additional supply, obviously it puts pressure on the market, puts pressure on rent growth. CBRE reported 2.5% reduction in rent from the prior quarter and just under 1% in occupancy. But you know, Utah has a great economy. It's ranked one of the top states in the country. The economic fundamentals are there, and it will take some time to absorb this new supply, but overall I believe the market will and the investment will still, you know, get a good return. And it is a long game. We have heard that multiple times, that real estate investments in for the long term, and this is just a blip and maybe a right sizing of the market that, yeah, again, we experienced phenomenal growth over the last 10 years.
Yeah, over the course of your career, right, you have managed through multiple market cycles, and even with this absorption period that we've got going on, as you call it, you have your team focused on a market plus one philosophy. Tell our investors what that is and how you get everyone to focus on that.
Yeah, so Market Plus One is a standard that I have set for myself and my teams throughout my career. And that is, regardless of the market condition, whether we're in a down market or an up market, that we're going to operate our assets better than our comp set, better than market. For example, our year-over-year rent growth as of last month was 6.5%, and market was, or 5.5%, market was 2%. Our NOI growth was 6.5% and market was 5.5%. So again, operating better than market, we believe that our teams are better and can lean into the challenge of a downturn by delivering exceptional customer service, a great product, and a high renewal strategy. We'll be able to weather the upcoming storm.
And Graydon, your team does a similar thing. You focus on numbers, trying to beat market all the time. How do you do it?
We do. You know, again, we take a cue from the airlines, right? The airlines have a perishable commodity in their seats, right? If that seat doesn't get rented that day, it doesn't come back to you. Same thing in hotels and with our guest rooms. And so we do all of our own revenue management in-house, which means we're pricing those guest rooms daily, we're pricing it weekly, we're pricing it monthly, you know, up to a year in advance. And all throughout the day to make sure that we're capturing the highest rate, you know, to the best customer on, you know, dozens of different sites. And our key metric here is revenue per available room. And you can see there where we compete. And so the key takeaway here is, you know, we're market makers. We like to have our assets be leading average daily rate in the market so that we're able to pull through the best performance for the property. This slide here depicts gross operating profit per available room. This gives you a couple of different metrics. One, how efficient are we as a management company and on-property team at controlling our operational expenses? And then secondarily, on the development side, it gives us an idea of, do we have an efficient building? Did we build the right size? Are we able to make that property, that size of property and scale of property profitable?
The Market Plus One then isn't just about driving revenue, it's also about expense control.
Correct.
And delivering the bottom line. And you're watching both of those metrics,
yes, sir.
Both of you. Right, let's jump a little bit into how you drive those numbers at property. And I've had occasion to visit property with both of you, and I see how much you care about the asset, you care about the team, but you also are constantly preaching about service. Service is an amenity, service is the distinguishing factor, and I think service is a little bit of PEG's secret sauce, right? So Deborah, maybe talk a little bit about how you instill that philosophy in your team.
Thanks. We talk about the PEG experience, and we recognize individuals within the PEG Property Group or PPG Group that deliver that experience. And I love this slide, I love this visual, because it shows that team members who are taken care of, who feel supported, who feel valued and mentored, are going to deliver a positive, strong customer service experience to our residents and guests. And in turn, that experience will cause our renters to renew, refer their friends. We'll get strong property performance and cash flow, which in turn makes our investors, makes you happy. So again, we're all interdependent on one another, and we track our online reviews. We watch them very closely. Every week we're tracking them. As Apartments.com sent a survey out and showed that 98% of the renters look at reviews when making a decision on where to rent. So we're very dialed in onto our reviews and what our customers are saying. Our average is 4.4 on Google. This property, Reedy Creek, Haiti, our manager there, just does a phenomenal job in that customer service and getting those reviews. They're organic, they're natural, and our comp set's right around 3.9%. So again, focusing on that customer experience, and it's evident on our online reviews that we see.
It's not unusual for corporate to receive an email about one of our managers because they are so focused on delivering that. And Haiti lives that
She does.
day in and day out, right? Do you want to speak to this slide a little bit?
Yeah, so part of that is the curated experience that we've talked about is providing a great experience, right? A living space that they can call home, and home is where life happens, right? And it's having living spaces that are thoughtfully designed, functional, they feel good, common areas that are, memorable, again, functional, fun, amenities. Many of our renters are renters by choice. They could go buy a home, but they choose to live in an apartment community for the convenience, the amenities that are offered, and the lifestyle that's offered. So we're really helping them provide the lifestyle that they're seeking.
And Graydon, we have to measure this in detail at the properties, right? You track GSS, guest service scores. Talk a little bit about that.
We do, and just for awareness and full transparency, I didn't bring only slides that show that we're at the top of the market. With this one here, you can see that it's really volatile. You can take a tumble really quickly with a handful of reviews that come in, and it brings you right back down to baseline. But in general, we're having to track and measure every interaction with a customer. I would say that in our portfolio, we're going to rent close to 1 million rooms this year, and it's hard to control what all of those interactions are going to be between your customer and your team member and your facility. But we work diligently to try and set those facilities up to be 100% guest ready every day, so that we can successfully excel and succeed guest expectation.
Yeah, and as you track that, that's what is delivering the service, right?
It is.
Yeah, I love that. We've talked a lot about vertical integration in action. We've now talked about how we have to deliver a property. So maybe, Graydon, you go first. Let's touch on how does vertical integration in our organization affect you, and how do you affect the other groups?
Yeah, I guess the first thing I would say is it's really a thank you to Rob and a lot of the team that helped to develop the office that we're currently in. That office environment allows and enhances collaboration between team members, where you're really only a door away and able to really get to the table really quickly. The other piece to it is, although we are deploying technology that's specific to measuring hotel pieces that we use to deliver returns to our investors, it also allows us to take that information and really utilize it quickly to really enhance and improve our underwriting on projects, because we're not just taking a percentage of what we think it might be. We're taking actual labor costs from a hotel that we're operating, and we have real-time numbers and real-time data that we can insert in there and really help shorten the learning curve in terms of our underwriting.
Across multiple markets, right? And that really, Lauren spoke earlier about the acquisition of the Residence Inn in Salt Lake, and the team relied pretty heavily on your group saying, where can you get the bump on this based on management that was in place
Yeah,
and us taking over it,
Yeah,
right?
for sure. And being able to have some of those like brands to where we know exactly how we're staffing it, who's in what positions, what those cost, how many hours that, it requires for a particular duty on property per day is really powerful.
Deborah, you came to us with an asset management background and a property management background.
Right.
And we find you actively involved in every stage of this investment process. Maybe talk a little bit about vertical integration from your perspective and how it affects the properties.
Right. Yes, I think vertical integration actually yields a better result, a bit better investment plan from cradle to grave. If every touch point of that process is thoughtfully executed and understood, then we get a better property, again, a better end result. I work closely with the analysts in underwriting, understanding our demographic, our comp set, our product, what kind of amenities should we do, how does this product fit within the market, what are the future fundamentals look like, and how do we drive value, right? At the end of the day, it's about returns, getting the results, and how do we do that? And are we building the right product for that? And love that close association with, again, underwriting, development, construction, and then through, operations, executing the investment plan, making sure, I'm always preaching, back to pro forma. What did we tell the investors that we said we would do? Are we executing to the original investment plan, and are we hitting those expected returns? And then disposition and, exiting on that side. So I think it's very important because, again, we have a lot of great experts within PEG, and working close together, I think we can, again, deliver the best results possible.
And you have both gotten actively involved in the design stages, the physical nature of the asset, because hey, how a person addresses the property, comes in, their experience is going to affect the rate that we can get when we rent to them, right?
Absolutely.
And we've also pushed on the backside of that some asset management responsibilities down to our property managers, all the way down to our property manager and our general manager on property. And Graydon, maybe talk a little bit about how that affects expense management and delivering on the bottom line.
Yeah, I guess what I'd give you is a very specific story and the power of having your general manager understand the invested dollar and how these properties are paid for and what his or her responsibility is to return invested dollars. We have an AC hotel in downtown Salt Lake. It's 164 guest rooms. A few years ago, and outside of the life cycle, some of the TVs started to go dark, and you call the brand, and LG said, well, you just got to replace them. And our general manager just didn't take that as the best answer, and the same for his maintenance engineer. And they took a TV down to a local repair shop where they'd taken some things in the past, and found out that there was a couple of bulbs and a strip that needed to be replaced in those TVs. And I guess I got to back up. The cost to replace the TV is about $700 per TV. They take it in, they do work on a few of them, find out that they can get this repair work done. Well, the repair job costs you $260, so that's not really an immediately great fix. But they took the pieces back to the hotel and they started to Google search, where they could get these pieces. Understanding that they didn't have money in their CapEx budget for that year to replace TVs, and plus it really damages your returns. So they started Google searching these things, and they found out that they could buy all of these parts, for about $14 a TV. That plus the hour worth of time, and so long story short, that saves the asset about $115,000 in capital improvement money that would come out of the CapEx fund, and gets it done for about $3,000. So the power is in having your on-property team members be aware of what their role truly is. Yeah. And it's to be proactive in what they're doing and how they're running their business.
And knowing all the numbers, right? Well, just as we close this up, you're the market experts. You're the boots on the ground, like I said. So, Deborah, where are we going? Give us your future forecast.
Well, I love multifamily. I think it's a solid investment, along with commercial. Commercial, we're facing some headwinds there as well. But I think the focus, and we lean into the challenge, As operators, we need to continue to hiring the best talent to execute. I like to help them understand, yes, you're managing a property, but you're really managing cash. And you're managing cash to deliver a return. And helping them, our property teams and our regionals on up, have more of an asset manager value creation mindset, I think is critical. Helping them feel valued and appreciated so that they in turn deliver that exceptional experience to our guests. Having a clean, memorable product so our residents have a great experience and refer their friends will yield a good, strong property performance and return.
I love that. Graydon, where do you think we're going?
Well, we're in for another really good cycle, I think, in hospitality. It's been reflected on today, that period of time from about 2010 to 2020 was, they were almost golden years. They were really great, consistent growth. Where we are in this low supply to deliver environment, plus average daily rates growing for the foreseeable future, we're in for a really good stretch in our industry, and I'm really excited to be part of a team that's going to figure out how we get developments done and how we bring properties forward in this period of time. We've got really, really strong partners from the brand standpoint. Cameron touched on these with Hilton, Hyatt, Marriott, IHG, the opportunities that we have. So as a hospitality group, I guess what I would leave with this group here is we're laser focused on creating great team members and supporting our team members at property with exceptional training and things so that they can deliver on what the experience is that the brands are asking, because as we do that, we'll be able to drive ADR, we'll be able to drive bottom line dollars, and have this group understand that we're laser focused on controlling expenses so that we push every dollar we can to the bottom line, and back to you for trusting us.
I love that. I mean, it's clearly all about delivering that experience at the property level, right? And we actually have a surprise for all of you. We want to deliver a delicious piece of that experience to you, so we're going to invite our team in to do that. And Graydon, I want you to tell this story about this cookie that we're sharing and Wood Ash Rye. For those who don't know, Wood Ash Rye is our restaurant down in the Avenir. And I think everyone who walks in the property thinks that they own it, and I don't know how many people own that property. It's so great, right?
That's for sure. That property is unique, and if you haven't been there, this is my personal invitation to get you there. I hope many of you have been there. When Cameron talks about a curated experience, this property is all about that. You know, there is assembling the property, there's assembling the partners, there's going through a branding process to deliver what the brand is and what it will be for that market. And then for us as operators, it's going out and finding the right people that can help us really pull that brand through. And this cookie is the product of Liz Foster. Chef Sean Foster was our partner for Wood Ash Rye and helped us curate that brand and pull that brand through. His wife is somebody that really helped establish the bakery portion of what that is. So this cookie is a product of hers there. If you haven't been there, you also need to try the bread. You need to try the biscuit. The biscuit is crazy. It's crazy popular. But those are all things about pulling through and making sure that the brand has life and is something special. And she went through about a dozen iterations of this brand. And one night before I left the hotel, I was driving back to Salt Lake about 4 days before we opened. She sent me home with about 6 of these. So it kept me busy.
You ate them all the way home from St. George,
we hope you enjoy this. This is a product of Liz and Chef Sean Foster and what they have done there at Wood Ash Rye for us.
This is the personal touch that happens at every property. It's not just about cookies. And Graydon and Deborah, thank you for sharing with us your expertise. And on behalf of all of our owners, thank you for caring for our assets.
Thank you.
Thank you.
Thank you. Okay, so I want to thank you all for joining us. We hope that this was a program that was beneficial to you and helped you to better understand PEG from a 360-degree point of view, as well as all the different groups within PEG that are working so hard to deliver and maximize returns. I wanted to thank our external speakers, Ian and Kimberly and Chip, for joining us today. I want to thank Garrett for joining the PEG team and for Cameron for finding him and I have 1,000% confidence in two of them. I mean, let's face it, I report to both of them. So, Cameron has my heart. He is one of the greatest leaders I've ever worked for, and I rest assured everything is in good hands. Cameron always does what's best for the investor, and I know Garrett will too as well. A few housekeeping items. This meeting has been recorded, so the recording will be available on the website. Also, all the slides that you have seen will also be available for download. I know that a few of you have reached out to me about specifics on your investments. Because there's so many, we're unable to do them one by one here, so we did do the high level with Craig. But if you have any questions on your investments, if there's a multi-asset investment like a fund, we do quarterly reviews. I would encourage you to attend those and to listen to the recording. If you are unable to attend, or if you don't know how to get into the investor portal to read the reports, reach out to us. We will find time to sit with you over Zoom, Teams, in person to review our investments. So please do not hesitate to ask. I don't want anyone to not understand what is going on with their investments, so please do that. Let's see here, what else here? I think that's it. So we have lunch for you at the rehearsal hall, which is just a short walk away. And, you know, until next year. So thank you everyone for being our friends and support and our investors. Thank you.